field, since you're a field
Yeah,
since
yeah,
you're a field engineer, you could always make that money back, right? Where there's limited, maybe they got maybe 10 years left, and they got to get moving, right?
yeah, and totally, like a lot of people, it's not really safe to be working in the industry and have all your eggs and investments in the industry. It may not make sense to them. So I don't blame them, but yeah, I think looking back, I mean, I was always shocked that I missed the 2008 opportunity. Obviously, I was too young at the time, but stocks like Baytex and Trican 10x in a year, and I was like, okay, the next time this comes, I'm gonna back up the truck and put everything into it. And I I saw the risk reward being very very skewed, and yeah, just went from there, and it's been uh, it's been a good ride, I think, for anyone who's been in the energy trade since March. Yeah,
Absolutely, Shabam. It's 12 right now. We'll get started, but keep this podcast episode or interview at the back of your head. I think you've got a profound story, a remarkable story to share.
yeah,
We could talk about it a little more offline, but it's 12 right now, and everyone's super excited, and we're looking forward to this session, Shabam. Do your magic.
yeah. No, you betcha. And for sure, we can talk about that later. But appreciate you getting the word out on Twitter and LinkedIn and such. So it's been good. And thanks again, everyone, for attending this session. I see a few names that were at the last one, and I see some new names. So that's really really good to see. Um, a little bit about the session, I guess. We'll go through a little bit of a macro outlook and what I see, the data that I'm looking at, and the kind of things that are more on the macro side, and looking at the future of oil going into 2022, going into the winter season. And then based on that, we will value 3 different companies. So I received requests over the last couple of weeks. A lot of people were interested in Gear Energy. A lot of people are interested in Surge, especially with that being one of my largest holdings. And then last time there was a comment on ARC Resources, because people wanna go in more into the gas name. So we'll do a little bit different on the gas side, and we'll go from there. I guess a disclosure: I'm not an investment advisor. Everything here said is opinion. Please do your own due diligence on these stocks. I'm always open for conversation, but nothing I say is a guarantee that the stock will make money or etc. So please keep that in mind. This seminar is recorded. It will be available on our website. The seminar 2 is already available. It's about a 3-hour session, I believe. So we'll see how long this one goes. Great questions, great discussions last time. Really appreciate your feedback. Feel free to interrupt me anytime you want to jump in, ask any questions, and yeah, let's get started. So can everyone see the screen here?
Yeah, we see it.
Yeah, cool. So a little bit about White Tundra. I've been investing in oil and gas for the last a little bit over 8 years now, but I only really got super invested looking at the deep dive into these companies kind of earlier 2020, and figured out a method that was working for me, a way to compare companies relatively to each other. And basically that's what I'm going to share today. It's a method that's used by a lot of investment professionals, analysts. There's also other methods out there. So this is not the end all be all. But yeah, this is what I use. So we'll get started with a little bit of updated pricing on what's going on, a macro outlook again on the overall supply demand worldwide, a little bit on the inventories, and then we'll jump right into the company valuations. I have a spreadsheet that I use, which I'll screen share. For the interest of time and ease, I can share the spreadsheet later to whoever wants it and wants to run their own calculations, but I find it's gotten a little bit messy if everyone follows along on the spreadsheet. So we'll just follow along with me, and then if anyone wants the spreadsheet after that, I'm more than happy to send it over for you to run your own calculations. So pricing on the WTI side, we see a 5-year chart here where we're at the top end. We're at the top end of our range. $80 oil we haven't seen in 7 to 8 years. There was a comment made a couple of days ago on Twitter about how people are panicking that oil is not continuing rising, but fail to realize that we're at a 7 to 8 year high. And companies are really generating a lot of free cash flow that they haven't seen over the last few years. Companies are a lot more optimized. Their operating costs are lower. Their G&A costs are lower. They've worked on their technology on the drilling and completion side. So there's a lot of other factors where $80 oil today is not the same as an $80 oil 7 years ago either, with inflation and the cost savings that have come over the last few years in the bear cycle. And we see Henry Hub. This is a 20-year chart. Again, we're at 10 to 12-year highs. We have seen a little bit of a dip on warmer weather, but as we all know, natural gas is our widowmaker, and it can jump and spike. Weather trends can change substantially in a very short period of time. And it's something that I've been keeping an eye more so recently, given how volatile this commodity has been. And there's a lot of good trends that are posted on the weather modeling side. I don't fully understand these trends, to be fully honest, but I'm still learning these trends, and I think they're quite useful at looking at these gas plays more so, which is kind of a new area for me. I've mostly been in oil plays for the majority of my investment history. Moving on to Canadian pricing, we see WCS is it's at a 7 to 8 year high. It has dipped in the past couple of weeks. There's a few interesting reasons for it, which were discussed a couple of days ago. With Enbridge Line 3 online, we're seeing a lot more heavy oil going into the States and a lot more supply of it. The cap line reversal has added a lot of demand to light oil. Going into the next year, it will switch to heavy oil, and we see this differential tightening again. The other thing to understand is that $61 WCS today is about 75 Canadian, and in 2014, when WCS was at these levels, the Canadian dollar was on par with the American dollar. So at that point, an $80 US WCS was an $80 Canadian WCS. Today, a $62 US WCS is a 75 plus Canadian. So, there's a bunch of theories on the Canadian dollar strengthening. I don't want to speak to that, but just keep in mind that the companies trade in Canadian dollars, and you want to look at all cash flow in terms of Canadian dollars, and they're getting $75 to $80 Canadian, Canadian for their WCS today. On the AECO gas side, we see very, very strong pricing into the future. For those who've been in the trade for a couple of years, AECO used to trade in the negatives in the summer, and then winter pricing was all over the place, jumping from $1 to $4 and back to $1, sometimes in the same week. So we're seeing a little more stability on these. The curve is still backwardated, so a lot of supply is coming forward. There's a lot of shut-in wells. There's a lot of choked back wells that companies are firing up. So you will see a little bit of extra production come up, and that should tail off because, as we know, gas wells don't produce forever. There's a pretty big decline curve on gas wells, and the Canadian industry is by far the leanest operating industry for gas wells in the world, really. And some of their all-in costs are less than $1.50 a gigajoule. So even when you look at $4 Canadian gas, it's a huge cash flow and a huge profit margin on these. Are there any questions so far? Feel free to interrupt me anytime. Moving into the supply demand, this is our total US crude inventory. So we see we're almost at levels that were last in 2013 and 2014. A lot of this is due to the fact that over the last 7 or 8 years, the US has released almost 80 million barrels from their SPR, which is their strategic petroleum reserve, which is only to be used during military conflicts or times of extreme supply problems, but it's being used as a way to tamper the oil price. So when you look at the total US crude, which is your SPR plus your regular crude stockpiles, we're at a range that's kind of in the area when we had $100 oil, $100+ oil. Moving to gasoline, we see we're well below our 5-year range, our 5-year average. We see that with gasoline pricing at multi-year highs, we still see our finished gas supply being above 2019 levels coming into the winter slow demand season. And we're seeing the same for distillates, which is your diesel fuels and a few of your heavier blends. We're sitting at the lower range, and distillates is a little more important because if we see a colder winter, a lot of distillate is being used for heating oil and for warming up the whether it's residential or commercial. So the fact that we're sitting at such low stockpiles and gas pricing being so high, it sets us up for an interesting future where a cold spike in the winter could really draw distillates down and put extreme pressure on pricing. And on the distillate product supplied graph here in the bottom right, we see we're above the 5-year average, holding steady there. And as winter comes in, we'll see this continue. This is the Saudi inventory. So the darker line is your crude inventory. The lighter lines on the bottom are your total product. So there's a lot of chatter about how much supply is really out there. Well, if Saudi really has extra supply, they might have been using it to refill their inventories, but we see that's not the case. The inventories have consistently declined from 2015, where we now sit at very low levels. And it's an interesting graph because we haven't seen these inventories go up at any time. So basically, Saudi Arabia has been pumping a lot of their extra exports and internal use from their inventories, and they're not restockpiling them. So again, as we go into a supply demand curve into the future, we see that there's the world's largest producers don't really have that much extra inventory sitting around in case of a colder winter, or in case of a demand shock, or in case of a supply reduction, as we saw with the hurricane recently, and a lot of the Gulf of Mexico platforms going offline. On the demand side, extremely strong. We see weekly gasoline demand picking up counter seasonally in a time where it usually drops. We're seeing highs, monthly highs. We're seeing seasonal highs, and that's with gasoline pricing being at incredible highs. So, with the talk about Joe Biden doing XYZ to cool down the pricing, if they end up reducing some sort of taxation on these gasoline pricing, we could see this demand go to even higher than we had in the summertime. So it's kind of an interesting graph. It's one that I keep an eye on pretty regularly. This is very good data by Gas Buddy, and it's updated almost daily, so it's easy to keep track of. On the right, we have our commercial flights, so more on the jet fuel side of things, and we see that demand has dropped off a little bit, but it's still very close to 2019 levels. And with international travel resuming on November 8th, we expect to see this continue going up, and more people going out into Thanksgiving, into Christmas season, and then into next summer as we continue on. Again, on the jet fuel side, this is our net change in ticket sales 2019 versus 2021. So, we see that the bookings have come up in the last couple of months. People are more confident in booking travel, whether it's today or whether it's future travel, and this is expected to continue going up. And I don't see why it wouldn't pass 2019 levels, as this whole pent up demand of people who haven't been able to travel over the last year and a half get on the boat and or get on the plane, I should say, and make the bookings and start traveling, adding to jet fuel demand. Any questions so far on any of these inventory or demand slides? No, we'll continue on. More on the demand side, so this table on the top right, which was discussed at the last seminar, basically China doesn't want to buy or import crude to the extent that they were. So what they've done is start going into their stockpiles. There's over 1 million barrels a day that they're pulling from their inventories, which can be seen between September 19th and October 24th. They pulled 35 million barrels out, and I'm sure this pace has only gone up as demand keeps going up. On the bottom right here, we see that China, Sinopec, they're planning to raise November and December diesel supplies by 50%, which again is going to pull on not only your crude inventories, but also pull on your finished product inventories. And on the left here, we have China's crude oil imports. We see it's gone down substantially over the last 6 months to a year. Well, as these inventories go down, China will have to come back to the market. And the difference between the top end of this curve at 50 plus million and the bottom at 37.7, where we are now, is about 2 to 3 million barrels a day. So we expect this demand to come back maybe earlier in the new year, or we could see China switch their strategy and say, hey, we see oil price continue to climb, so let's buy it now and avoid having to buy at $100+ oil in the new year. This is our American oil rig chart. So we look at the top curve, and people are saying, why wouldn't America just come back and start drilling these shale wells? And they look at the top curve, which is a 1-year American oil rig chart, and they say, oh, here we go again, jacking up production and spending money. But when we look at it from a 3-year perspective and our pre-COVID level, we're still only about 2/3 of the way to where we were pre-COVID. And it's important to note that pre-COVID, for all of 2020, the first quarter of 2020, American oil production has stalled out. So at about 700 rigs, we were not increasing production at all. We were just making up for our base declines in production. So the fact that we're at 450 right now means that we will continue to drop at this rig level. Production has gone up because people are activating shut-in wells, people are completing drilled uncompleted wells. So there's a little bit of a gap there. But once that is exhausted, we are nowhere near the amount of rigs required to keep production flat. And I've been hearing about rig efficiency for the last 3 or 4 years. Well, there's got to be a limit to rig efficiency. You can't just keep drilling and getting more efficient as you go, especially because the tier 1 wells, which is your best acreage, has already been used up. And a lot of the wells being completed are the drilled uncompleted wells, which are not really the best of the best, because if they were, they probably would have been completed and put on production already. So I'm not a genius on the whole rig efficiency thing, but I just don't see how it can keep becoming more and more efficient. Seems like there's no end to it, according to some of the comments I see out there. These are the drilled but uncompleted wells that I've been talking about. So some of the companies, what they do is they drill a bunch of wells on the same pad, and then they don't complete them. They'll wait until the first few wells kind of decline off, and then they'll complete them, or they just want to wait for whatever reason. And we see the extremely sharp slope here on this curve. We're down to about 5,000 DUCs left. The consensus or my view is that there's about 3,000 of them which will never be completed because they're dead wells. The formation has collapsed on itself, or the wells are just not economic. They haven't shown what we would call an economic well based on the coring, the well logging, the sampling, etc. So it's getting pretty tight. And if this slope is to continue, we only have 3 to 6 months of DUC left, and not all the DUCs that are economic will be completed either, just because there's not enough capacity in the pipeline, there's not enough gas offtake, or for a variety of other reasons. This is a slide that I discussed last time as well. So the US in early 2020 had become a net exporter of oil and petroleum products. So they were exporting roughly 1 million barrels a day of product and oil combined into the market, sending it to whether it's Asia or China or wherever else. And over the last year, we are now back to zero. So America is using up 1 million barrels of extra demand that was previously available to the global market. So, it comes back to the same point. Every country and producer is using a lot more than what was previously available. So although people see American inventories and see American demand and use that as kind of a bellwether, we have to understand that America is pulling oil from offshore waters and from other countries' supply chains. And there's an artificial almost supply demand there that we have to deep dive into it to see this extra demand that's out there.
I have a quick question in regards to like how America is now a net importer again
Uh-huh.
in regards to, because in the last decade or so, in regards to shale, a lot of companies like infrastructure, MLPs, export terminals, do you think that will reverse? Because you can see companies like Cheniere with their LNG projects and a lot of other companies set up that try to reverse the U.S. infrastructure where, before they was all imports, now they try to export energy. Do you see it could reverse?
So from that kind of standpoint, yes, there is a lot more extra LNG demand, and there's a lot more there's a lot more LNG export capacity, and there is a lot more crude oil and petroleum export capacity. Correct. However, this this graph itself shows the net of your imports and exports. So if America starts going back to a net exporter, that would mean that they're pulling from their own inventories and demand. So, we could see that America starts exporting a lot more of the heavier oil crude grades, but they would have to make up for it by importing the lighter grades, or by importing gasoline or importing distillate directly. So it's a good question, and I think what's going to end up happening is America is going to start exporting more and also start importing more. So your net basically stays at zero unless there's a major shift in the supply demand within America itself.
Okay, thanks for.
Yeah, you betcha. I appreciate that. So last time there was a comment made that maybe I'm just talking into the wall, and what do the experts and analysts believe? So here we see that Goldman Sachs has put out a $90 barrel Brent forecast. This is for the end of the year, and they already see upside risk to it, in that they think there's a possibility that even $90 barrel Brent is going to be eclipsed. So there's a full write-up on this. It goes into detail about the colder winter, the gas to oil switching, and other factors. And the next one here is RBC's Michael Tran, who has been absolutely bang on the whole cycle. He's a guy who I started following in kind of mid 2020, looking at his interviews on Bloomberg and his write-ups, and really started following what he was saying from a global supply demand scale. And he just had another interview here, I want to say not too long ago, maybe a couple of days ago, and one that I would really recommend, that if you want to get into the nitty-gritty, it's a good one to watch. And feel free to message me, and I can send you the link for that. And basically what he's saying is that this is a multi-year structurally strong cycle. This is not a pump and dump cycle on oil. This is one where we see both a lack of supply and very, very high demand, especially with all this pent-up demand that's sitting there waiting to be booked, and people wanting to do road trips and fly and travel, etc. Bank of America recently came out with this forecast about Brent going to $120 a barrel by June 2022, with the global gas prices, air travel, and then Asian demand has been coming back exceptionally strong. Indian oil demand is at all-time highs. European demand is very, very strong, especially European gasoline demand. And with the gas to oil switching, we see an extra 1 to 2 million barrels potentially of demand with European gas where it is. And then the last one here is by Vital, which is the biggest oil trader globally, and they're saying that market supply demand is going to be reasonably tight for the next 12 months, and a price spike to $100 a barrel is a possibility. Vital has been known to talk their own book and try to do their own thing there, but I think the fact that their view is also agreed upon with all these banks and other funds. I think when you look at it overall, we see kind of the same thing based on the macro that we've been talking about here. So the left graph here, I get comments all the time about hey, stocks, oil equities have already 5 to 10x some of them over the last 18 months. Is it too late? Well, if we look at this cycle so far, we're just getting started. Energy still makes up a very small portion of the S&P index. A lot of these cycles are not a 1-year cycle. They're long cycles that tend to slowly grind up, and we see these cycles being shortened in current times just because of the pace that the market moves at is much faster than even 2008 or 2014. But that being said, when you look at the y-axis on this graph, we still have a long ways to go, and it could be over the next, it might not take the 80 months or the 70 months that these past few cycles have taken. It might be a more concentrated cycle this time around. And then on the right, we see our free cash flow that we're generating. So as I kind of mentioned earlier, a lot of these companies have really knocked down their operating costs. They've knocked down their drilling and completion costs. They've knocked down their extra interest costs and their G&A costs, which is like employee salaries and office expenses, etc. So we're seeing companies generate more free cash flow in Q3 than we've seen them generate even during $100 crude in 2014. So the point being that if we do see $100 crude this time around, our free cash flow is going to be way higher than it was in 2014. And we can go back and look at stock prices in 2014. Well, if the companies are generating a lot more free cash flow, it just bodes well for any investors who are invested in the equities directly. This is more on the global demand side, and an interesting graph that I found recently, which shows that on the x-axis is the Human Development Index. So basically, put in better words, it's basically the quality of life. And on the left is the amount of energy used per person per year. And it's a pretty linear curve until you get to where China is about right now, where there's a huge booming middle class. And as we increase our quality of life further from that point onward, the extra energy required is much higher. It's almost an exponential graph that it becomes, and you can see where America is here on the top right. So as these countries that are in the area where China is right now start to want a higher quality of life, they start to want their own automobiles, they start to want to travel more internationally, the demand is not going to increase linearly, it's going to increase exponentially. And a lot of these countries that are in the area where China is right now are very high population countries. So going into the future, there's all this talk in the media about peak oil demand and how oil has peaked. But when I look at this graph, I see all these people in this box here who are wanting to move a little bit to the right, but to move a little bit to the right requires a lot more energy than it did for them to move over the last few generations. So this is a slide that when anyone says peak oil demand, this is a slide I show them, like, here you go. These people are wanting to move further to the right, and the energy required is much higher on a per capita basis. Any questions on this so far? This is kind of the end of the macro outlook section. We'll get started on the valuation section. If there's any questions, feel free to
I'm pretty good thus far. Thanks, Shubham.
Okay, right on. So we'll get started on the valuation slide. So we'll get started with Gear Energy, which is a company that has been mentioned a lot for being kind of the best of the best, and I've got a lot of questions about it. A lot of people who want to do the valuations on it. So we'll start with this. From a financial modeling standpoint, these valuations are very, very basic. They're kind of built for the average retail investor to go through them without being overwhelmed or without having to know a lot of in-depth accounting information. From an oil standpoint, a knowledge of the oil industry, I would say it's a little more on the intermediate level. You know, we do expect that you would know kind of the difference between oil and gas and where it's traded and the fact how the industry kind of works. You still don't need any type of advanced knowledge at all. So there's that. And then I will say there are a few people on this call, I believe, who have worked as portfolio managers, as equity analysts. Some of the calculations have been reduced to a more basic way of calculating things. There's a few things that have been ignored for the sake of ease of calculation, just because they don't affect the end value all that much. Now we at White Tundra, like I would go through these in-depth adjustments, but then we would be sitting here all day long doing valuations on one company. So yeah, so let's get started. So can everyone see the seminar calc spreadsheet?
Yeah, we see it.
Perfect. My seminar calc. So I'm just going to open up the Gear Energy files, the files that were sent with the email. There's a corporate presentation, and then there's our Q3 results. So whoever would like to follow along, I'll just wait a couple minutes so you can open these files.
Thanks a lot, Shubham, for choosing Gear Energy. I was going to ask you about it today. This is Sharif.
Hey, Sharif, good to see you again. And yeah, I know you had mentioned it as well, and I know there's a lot of other people who were interested. So I'm glad to go through it.
I appreciate it, man.
Yeah, you betcha. Okay, so we'll get started. So the first things first, we just put the company name in. So Gear Energy. I make different tabs for each company that I'm evaluating, so it just makes things easy. A lot of the information is really easily accessible because the companies just released their Q3 results recently. So we've been lucky with that. This is kind of the best time to go through these calculations because you have these updated numbers that are basically, you know, not just over a month old. So the first thing we want to put in is our production. So that will be in the Q3 results. The first page with this table has a lot of the information we need already in it. So the production is here under operating information. So we just put it in exactly as it is. we want to put in our liquids percentage because gas and oil are valued differently. A BOE of oil is almost always worth 3 to 4x what a BOE of gas is worth. And BOE is a barrel of oil equivalent. It's an easy way for companies to show their production in terms of barrels of oil equivalent. So for the liquids percentage, we basically add the heavy oil, we add the light oil, and we add the natural gas liquids, and we want to divide that by the total BOEs. So in this case, it's about 4,100 BOEs of oil divided by total BOEs of 5,800. So it's about 70%. You can kind of run the calculation yourself as well. I did make a change on this spreadsheet that was recommended to me, which is that for whoever has the spreadsheet, I can send the newest copy out. But on the right here is basically an explanation of all these rows and exactly what they mean. So there was a little bit of confusion last time as to what exactly I'm putting in. So this is all here, and whoever wants this updated copy, just let me know after the seminar, and I'll be happy to forward it over. So for the number of shares outstanding, we're going to go to the corporate presentation, and it's page number 4. On the bottom left here, we see outstanding shares is 259 million. So we're going to put that in millions. The share price, I believe on Friday, closed at 108. So we're just going to throw that in there, which gives us our market cap. So what the market cap is basically what is the value of all the shares in the company combined. So the way that's calculated is your share price multiplied by the number of shares. So relatively easy calculation. Again, nothing much to it. The net debt is available on the same slide here on the top right. So 27.9 million. So we're going to put 28 in there, and we get our enterprise value. The enterprise value of the company is what's the company worth if you add up your shares and your debt. So what is the total value of the company combined? And a lot of calculations use the enterprise value because debt at some point has to be paid back, or it has to be used in some way. So we got our debt to EV ratio, which tells you of the entire value of the company, how much is debt. So in times of low oil pricing, debt is a concern because debt is the reason that companies go bankrupt. It's not a low share price. It's debt and lenders coming to you and saying, hey, you must pay back XYZ loan today, and companies just don't have the cash to pay it. So Gear is a really solid company in that only 9% of their total company value is debt. So if oil price is to collapse for whatever reason, if oil price is to collapse for whatever reason,
Are you able to pull that guy out of the presentation?
yeah, I did kick him out, but I'm sure they'll be back in doing all this nonsense.
Okay.
So yeah, I don't know if you have any suggestions on how I can control that better, but
Are you able to like share co-host with me so I could manage that while you're presenting?
yeah. So
And then I could, that way I could just stay on top of it.
cool. Thank you.
Bobby Nugget coming in to screw you up.
Yeah, yeah. It's either Bobby Nugget or Bullish Bear having a bad time.
Or Petro Girl, because you're not talking about TV.
Yeah, maybe. Well, we'll mention Serge here, so she'll be happy about that. But so debt capacity is something that's more important to know with companies that have a really high debt to EV ratio. So if a majority of the company's value is debt, you want to really know how much debt capacity they have, because if they're really pushing against their debt capacity, you want to be careful in that a collapse in oil price most likely will bankrupt the company. So for a company like Gear, it's not important because their debt is so low that I just don't see a problem with it. The stay flat capital, again, is important for certain companies, but it's not really that important. So anything in orange basically does not go into the calculation. It's just a way to compare companies between each other. So we're just gonna leave it out for now. The annual dividend, Gear does not pay a dividend, so it's 0. And that goes to 0 there. The last quarter adjusted funds flow. So this is one of the most important pieces of information that you need to know. What adjusted funds flow is basically how much money does the company make after they pay their employees, after they pay their taxes, after they pay interest, after they pay anything to do with operating costs. So whether it's all the chemical they buy on site, all the optimization they do, etc. And that's shown here in the description. So for anyone that wants to do these calculations later, it's all there. Now, one of the confusions that I got after last week's seminar was that people were not able to find adjusted funds flow in some of these companies. And that's because adjusted funds flow, for some reason, has a bunch of different names, and there's no common name that all the companies use. So in Gear's case, it is funds from operations, which is almost $16 million. So we're going to put $16 million in here. Last quarter free cash flow. So the difference between adjusted funds flow and free cash flow is that free cash flow also takes out any expenses that the company had to do in order to keep production flat or in order to drill more wells. And the way that free cash flow is calculated is you take your adjusted funds flow and you subtract your capital expenditures. So Gear spent about $10 million in capital expenditures, so their free cash flow would be $6 million. Does that make sense to everyone? Some companies will explicitly show their free cash flow. Some of them you have to calculate it just because of the way they report things. But again, it's a relatively simple calculation. There's nothing in here that's extremely, you need to be an accountant or anything to figure these out.
Just to confirm, so AFFO, funds from operations, that's basically pre-tax income, right?
No, so that's income after you pay all your tax, all your interest, all your employees, you pay operating costs and everything except any capital expenditures.
Okay, thanks for the clarification.
Yeah, and then basically all you have to do is subtract capital expenditures from it, and you get a free cash flow. Now, free cash flow is also after the dividend is given out. In this case, there's no dividend, so we don't have to adjust for it. The way that this spreadsheet is set up is that once you put the dividend in on an annual basis, it will do the calculation for you. So you don't need to get into the complications of that. So the other thing we need to put in is the hedging impact. So a lot of oil companies hedge their production in that they make deals into the future that, hey, we're going to sell you this much oil in 2022 or in 2021 at this much pricing. And that way it's a locked in price. This is important to note because hedging is not permanent. It's only for a period of time. So in order to calculate how much money does the company really generate, we need to take hedging out of the equation and kind of like look at the company as a non-hedged basis. For some companies like Synovus, it's easy because they don't hedge, but a lot of E&P companies you will find will hedge. Sometimes they make money on it, sometimes they don't. And I'm just trying to find where exactly it is. So it's here on page 9. What you're looking for is hedging is more professionally called risk management contracts, and a lot of companies will use that terminology for it. So here we see on this paragraph here, for the quarter ended September 30th, Gear realized losses of $2.8 million on their risk management contracts. So because it's a loss, we're going to put it in as a negative in here. So if the company made money on hedging, we would put it in as a positive number. And that, I think, again, is explained in these descriptions. So the couple of people who mentioned that they wanted this description, thank you for suggesting that. I totally agree. It makes things a lot easier and easier to follow through as well. So that gives us the total free cash flow that the company made last quarter if they had not hedged, so $9 million. Now, what we need to know is this $9 million was made at what WTI pricing? So we go back here and we are going to look for the average benchmark pricing. So Gear Energy calculates that for quarter 3, the average WTI pricing was 70.56. So at 70.56, they made $9 million of free cash flow. This is important because the pricing is not always going to stay at 70.56. It's going to go up, it's going to go down. So we need to know what the difference is for Q4 and into 2022 going forward. And I got a couple of questions on this, in that Gear does not sell oil at WTI pricing. So why are we using WTI pricing? Well, if we start looking at all these pricing that Gear is selling oil at, WCS and Canadian Sweet, some of them are in Canadian dollars, some of them are in US dollars. It just gets way too complicated. And some of these differentials are not even available online. So for the sake of simplicity, we're going to calculate everything in WTI and then just take the little bit of a error margin on it, because that lets us do these calculations very, very fast, and then we can adjust them if we're really focused on certain companies. Does that make sense so far? Yes. So now, in order to value these companies into the future, we need to look at strip pricing. Strip pricing means what is the pricing of WTI for the next 12 months? What can we sell oil at today for the next 12 months? And the way we calculate this is a little bit different. So we need to go to Google, and there's a website called CME Group, which tracks the crude oil futures for the next, I want to say like 50 years or 30 years that it's tracking these for. We're only interested in the next 12 months. So what we do is we take the next 12 months of crude oil contracts, we add them up, all 12 of them. So we add them up and then we divide it by 12. And then we get our monthly average strip pricing. Does that make sense, or is there any questions on this side of it?
It makes sense. Yeah.
Makes sense, yeah.
Cool. And this CME group is open to the public. There's no subscriptions or anything you need. It's live data. So, you know, if you're calculating the same calculations for Gear on next Monday, well, you're going to have to calculate strip price again, because as the WTI contract starts trading, these numbers all change, and they change at different 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 values. Like, the December contract was down 90 cents, but the next December's contract was only down 70 cents. So either way, we get a strip pricing of $75.23 a barrel. So so put another way, what this strip pricing tells you is that if a company is to lock in their pricing for the next 12 months, they can lock it in at 75.22 dollars a barrel. This box in here is your other annual free cash flow sources. It's in there for certain companies that have gone through acquisitions, that have gone through a big layoff of employees, that have gone through some sort of synergy. In Gear's case, they haven't really gone through anything. So we're going to leave this at 0. And we're done. That's it. So the blue box here is a methodology that I use to value companies. So what we do is we have box 30 here tells us that at the last quarter's pricing, this is what the company would make annualized on an unhedged basis. And our free cash flow yield basically is how much money does the company make free cash flow relative to its enterprise value. So that's including its shares and its debt. The total value of the company, Gear is generating about an 11.4% return on that. After all its expenses, after they have spent all the money drilling, completions, and on equipment to keep their production relatively flat. So, pretty good rate of return. And the way that I value these companies is I want my initial investment in these companies to be totally paid back in terms of dividends or share buybacks or debt repayment in 8 years. So the company must generate enough cash on a free cash flow basis in 8 years to pay off the enterprise value. And it's a little difficult to explain this, but the way we can calculate that is by multiplying our free cash flow by 8. So in 8 years, how much money does the company generate? So we take our annualized free cash flow and times it by 8, and we get 282 million. So this is the amount of money that the company would generate over the next 8 years if you don't take into account inflation or discounting rates, which complicates the calculation a lot. And the other way to say this is that the company must generate a 12.5% return. And the way that I'm calculating that is saying, okay, if the company generates its entire value in 8 years, while each year it's generating a 12.5% rate of return, over 8 years, that becomes 100%. So the whole company is paid back. However, this FCF calculation is on a share basis. So we must subtract our debt to say, okay, this is the value of the company itself. And this 8x FCF calculation is one that's very widely used. I'm not going to say it's the only way to do things, but in the resource industry, for established companies with production, 8 times free cash flow is a pretty conservative slash mid-cycle kind of valuation. So what we're saying is that at this multiple, the entire value of the shares today is $254 million, which gives us a share price of 98 cents. For those who have discussed Gear Energy with me, and you've heard me talk about why I don't think Gear is the best play going forward, this is why. At last quarter's pricing, our current share price is already above what the fair share price is. So me personally, running these calculations, I don't see upside in this company particularly. Even at $100 oil next year, the stock price roughly will double using this methodology. Gear has excellent management. They always overachieve their production targets. They have really good transparency. They have monthly updates showing their production. They have done really well on the operating cost side. So it's fair to say that Gear is valued at a premium because of that. Are there any questions on this? It's a little bit, takes a little bit of time to wrap your head around. And as we do the next one, you will kind of see, it'll start to make a little more sense.
So just a quick question. So Shubham, when the idea is out there that, some of these companies could privatize in 4 years, 5 years, those references that are being made, how does that relate to the eight multiple that you're referencing here?
So basically, when somebody says that this company could privatize and pay off all its debt in 4 years, what they're basically saying is that if they value the company on a 4 multiple, the share price today, whatever you end up in this calculation will match today's share price. So for Gear Energy, it's even at an 8 multiple, the current share price is already over what the fair share price is. So Gear is really valued on a 9 multiple. So at Q3 pricing, it would take Gear about 9 years to generate enough free cash flow to privatize and pay back all its debt. There's other companies that are 3 years, there are other companies that are 5 years. They come with other risk reward profiles. Yeah, but I hope that explains it a little bit better.
I have another way also of stating this 8 multiple. So it's
Mhm.
basically like you can say I'm investing in an asset that will give me a return of, so over 8 years of return, it will basically cover the capital that I invested in this asset. It's like an interest rate or a dividend rate or yield of 11 point, what's it, 12.25 or 11.75. It's basically 100 divided by 8.
Yeah, 12.5%. Yeah.
Yeah.
Yeah. So that's the best way to put it. The actual rate that Gear is generating is in box 31. So it's 11.4% rate of return. So put another way, if Gear doesn't want to pay back its debt, they can pay out an 11.4% dividend every year. And if you compare oil and gas stocks to other industries, an 11.4% dividend is amazing, which is why this FCF 8 multiple in my mind is still conservative. Now there's a lot of talk about Eric Nuttall, and a lot of people on this call probably
Yeah, you're good to go. I took him out. Go ahead.
Thank you.
So
There's a lot of talk about Eric Nuttall. There's a lot of people following Eric Nuttall. He uses a different methodology that is 4 times adjusted funds flow. Sometimes he uses 6x adjusted funds flow. So you can adjust the spreadsheet to however you want. You can change up the calculations here if you want to use a 6 multiple. I like 4 multiples on adjusted funds flow, just because adjusted funds flow doesn't give you the entire picture of the company. Companies have different capital requirements to keep production flat. Companies have different decline rates. So I don't like using adjusted funds flow unless you're really knowledgeable about the industry and know companies in depth. But it is a way that people are using. So same thing. The way the spreadsheet is set up is if you believe oil is going to be $100 next year, this is your fair share price. If you think oil is going to dip to $50, at $50, gear is worth the equity value of gear is almost zero. So, that's why we saw such little interest in these equities, even when oil jumped from $20 to $50 to $60. It's only now that we're at $70, $80 oil that we're starting to see some interest pile in, because a lot of banks and analysts that don't understand the industry are using these sorts of basic calculations, and they're just not interested at $50 oil or $60 oil. So now some of you are probably wondering, well, hey, gear already has hedging, so we can't just take it out and then start evaluating share prices at non-hedged numbers. And you're exactly right. Like we can't. So what I do is I go into back to their hedging, back to the hedging information, which is again in the third quarter MD&A. Almost all the information will be here. You don't need to contact management. You don't need to go on their website and be looking for hours. Everything that we've required so far has been in these two files, whether it's a corporate presentation or the 3Q MD&A. So let's look at the future impact of hedging as to what gear has done. So for quarter 4, they have 2,000 barrels hedged. So we'll put 2,000 under barrels hedged. And at what price? So this is where it can get a little bit complicated. You need to understand how this hedging works, the swaps and the calls and the puts. I'll make it simple. If the price of oil in Canadian dollars is above the highest number here, they will make the highest number. Now, when the price of oil gets between these numbers, it gets a little complicated. But I think every company today has hedged below the current price. So we'll take these numbers. They have 800 barrels hedged at 74, 800 at 71, and 400 at 83. So, if you average it out, it's roughly 74 on the 2,000 barrels, or sorry, up here. And then for the next quarter, they have 2,400 barrels hedged at $86. And then this last hedge, that's for the second quarter of 2022, actually will not be exercised just the way that it's set up. So we'll just put, we'll just leave these blank, 0 and 0. And what this tells us is that for the next 12 months, gear will lose roughly $3 million on hedging. So on an unhedged basis, they were generating $35 million of free cash flow. While once we take the hedging into account, they generate $32 million. So our free cash flow yield after hedging and after everything is taken into account is actually only 10.5%. And the share value, the fair share value is 89 cents. And once I get to this part, I just leave it as is. I run the same calculation on multiple companies and I see which one has the most potential. So if I'll see 4 or 5 companies with the most potential in terms of the share price value increase. And then I do a deep dive into those companies. I'll look at the exact production estimates. I'll look at the exact budget. I'll try to get in touch with management and set up meetings on what their strategy is for free cash flow allocation. I'll look at their debt profile. I'll look at everything in depth. But unless you're really interested in the company and you see that relative to other companies, it is a better company to buy, a more potential company to buy, there's no point going into those in-depth calculations. So that's Gear Energy. Are there any questions on that? Any comments anyone would like to make? Anything somebody wants to add?
So the premium that you see for gear is just comes to the value of their management. Is that where you see it, or is there any other thing that you see that's allowing them to be a little more premiumly priced relative to some of the others in the space that's relative to their size?
So the strength of their management, yes, is a big deal. The fact that their management that can be trusted to do exactly what they say, where investors in the oil and gas space have gone burned over the last few years with investors kind of or management misleading them. I think that plays a huge role in it. The fact that it's kind of a name that's talked about a lot, I think makes a big deal. There's a lot of retail interest in it. They always outperform their budget production expectations, always. If you look at their monthly reports, their production is always more than what they say, or more than what they budgeted for. So, there's that. And then the other parts of it, I really don't have explanations for it. It's just whatever investors pick up on, whatever they want to buy. Maybe they've had gear for a few years and they're hanging on. I don't know, but this chart to me, and you'll see once we go through Surge and ARC, you'll see why gear is a name that I haven't even done a deep dive on, because it's so much overvalued based on this calculation technique that I use. And again, like, nothing here is investment advice. I'm not telling you to go out there and sell your gear shares on Monday. This is just my opinion. This is the way that I calculate these companies. This is the way that I do my investment allocations for my own portfolio and for White Tundra's portfolio. But the numbers are here, and yeah.
I just had a quick question for anybody else in the call. Like, is there anything else that anyone else might know that maybe we're not addressing within the current valuation model? Anything else that you've come across that you feel should justify the premium on gear? Just like an open question to all the participants at the moment.
Yeah, feel free to chime in if anyone has gear as to why they're, I guess, valuating it at what they are.
If you guys don't mind, would you mind just going again very quickly through the difference in methodology between you and Eric Nuttall, if you don't mind?
Yes, yeah, certainly. So the way that I like to value these companies is on a free cash flow basis. So how much money does the company make after they pay off, like for a lot of investors, they don't know, or they don't understand, or it's just like, it just takes up a lot of time to understand the decline rates of these companies, that why a company that's drilling in the Montney has a much higher decline rate than a company drilling conventional vertical wells in the Sparky or gas wells in the Edson area, etc. It just gets quite complicated. So what free cash flow tells you is that after the company keeps its production flat, so whether that's drilling one well, whether that's drilling 40 wells, you don't need to take that into account. All you're worried about is how much money does the company generate after everything is taken out and after production is kept flat, because oil wells and gas wells decline, unlike other resource industries like gold, where production can be kept stable with very little extra cost. Oil and gas wells decline at different rates. So a well that's making 100 barrels today might only make 50 next year, or might only make 20, or it might make 95. So that's why I like free cash flow, because for the average retail investor, it tells you how much money does the company make after everything. Now, I don't want to say that that Eric Nuttall only uses this second way of evaluating companies. It's just the way that I've seen him mention 4x, 4 to 6x range. There's a lot of other analysts out there that use other methods, but because a lot of funds and analysts in the oil space have very in-depth understanding of the different reservoirs, the different production profiles, and the different decline rates, they use adjusted funds flow. So adjusted funds flow is before any money that the company spends to keep its production profile flat. So, you know, it's more of an understanding of, hey, you know, let's say the company today decides, you know, we're not going to drill anymore. We're just gonna produce whatever we can from these wells, and then we're just gonna say goodbye and move on. So in that case, adjusted funds flow is a more important measure where you can say, okay, if the company just let production decline, how much money would they generate to give back to shareholders? And obviously, it's going to be higher than the free cash flow numbers. Like for me, it's not a good way of valuating companies, because there's only been one company that I can think of in the last couple of years that has taken this approach where they say, hey, we're not going to drill, we're just going to make our money and pay back debt and et cetera, et cetera. So I don't like using adjusted funds flow unless you have a very deep understanding of these companies and their properties and their assets, or you're relying on someone else to have that understanding and give you the final graphs or the final tables or the final multiples, et cetera. So if you're investing with a broker or a manager that's using 4x AFF but has a very deep understanding, you know, that's totally fine. But for people who are attending the seminar and kind of running these calculations yourself, I personally would stay away from using adjusted fund flow multiples. Does that answer your question?
Yeah, it does. Thank you. Yeah, it's a little deceptive, obviously, because if you look at one of the last, you know, he publishes these bar charts with that 4 to 6x target multiple that you referenced earlier, that you alluded to.
Yes.
And on the last version of that I can see, you know, he shows at $80 WTI, nat gas strip, Forex strip, and a $10 differential. He shows gear at, it looks like 2x. And, you know, on a relative basis, given his methodology, it shows that it's cheaper than virtually everything, except it looks like Cardinal and Athabasca. But appreciate you talking about the difference in methodology.
That's very interesting. I will go back and look at that, because I didn't realize that his methodology showed gear as that much undervalued. So I will look at that, and I will, yeah, I'll have a look again.
Yeah, it's sort of like it's in a vacuum anyway, right? Because it's undervalued maybe in relation, just on that metric in relation to other assets, but it doesn't account for the many idiosyncrasies about the projects and company and all that stuff. So it's sort of very single variable.
Yeah, no, you betcha. Appreciate that.
So Shubham, can I add my 2 cents here? I think so. Basically, it looks like your methodology is more conservative compared to the other one, which takes 4 or 6 multiple of the analyzed funds from operations. Correct? And basically, is that correct or not? To make this assumption.
It can be, depending on the company. So if the company has a very high capital cost, then my methodology will be a better way to calculate it, I think. But if the company has a very low decline rate, then, you know, the adjusted funds flow will show worse off fair share prices. But if the company has a very high decline rate where they're spending a lot of money on capital, then the adjusted funds flow will be less conservative and show more higher or fair share pricing.
Yeah. Okay. That makes sense. So I guess your approach makes very good sense when it comes to these companies that have high decline rate, which requires large amount of capex to keep production flat. Unlike these low decline assets, which don't really need to drill much to keep their production flat.
Yes.
So I guess that's my observation.
Yeah.
Not sure if you agree with it or not.
Yes, yeah, that's correct. And in most cases, the free cash flow is just an easier way to calculate it because you don't need to even look at decline rates. You don't need to look at anything. Whereas with adjusted funds flow, you really need to understand what kind of plays are these companies in, and what kind of money is required to keep production flat. So it for people who are more knowledgeable about the industry, you can use adjusted funds flow. Yeah, but for the sake of the seminar and the kind of people that it's built for, I think free cash flow is the only one we should use. But I mentioned 4x AFF because a lot of people are following Eric Nuttall and that's what he's using. I think on the graphs anyway. So I just throw it in there. Yeah.
Yeah, you're spot on. Thanks a lot, Shubham.
Yeah, no, you betcha. Appreciate the comment. So if everyone's good with that, we'll erase all this data and then we'll move on to Surge. Surge Energy.
Just one point to Shubham. In Worcester was mentioning something along the lines of, so the top section, if you go to the top section, he's saying the total oil liquid should be 50, what is it, 5,157? 5,000, how much do you have for total oil liquid?
I got 4101 is the liquid.
So he's saying liquid should be 5,157. Can we double check that real quick?
Which number are you comparing it with? Like where are you finding the number?
I jumped on Swab. So check that out, Shubham. The easier way to figure out your liquids ratio, if you're just taking your barrel equivalent on your gas side, just divide your MCFs by 6,000 as a 6,001 ratio for your barrels. So you're going to.
Hello?
You're cutting out there in Worcester. Did we lose him? Yeah, the reception might be a little bad for you, Wu.
Oh yes, I see where the problem is. Yeah, you guys are bang on. So it's actually 5,100 barrels out of the 5,800. So the liquids percentage would be around 85. Yeah, great, nice one. So 85 or 86%. So that's not going to adjust our current free cash flow, but for looking at pricing into the future, it does add a little bit more of torque, certainly. That extra 1,000 barrels of liquids production. So great catch. And yeah, so any other comments, any points, anyone who's owning gear who wants to make any other suggestions or feedback or anything, this is your chance. And I'm always open to discussions after the fact, or if you want to call me, email me, etc. I love talking oil and gas stocks. It's oil and gas is in my veins, so it's always appreciate any feedback, any suggestions.
I hope you don't mind me jumping in. Can you hear me?
Yeah, go ahead. Yeah.
Yes, Kalichi, we hear you. Glad you could join us, Kalichi.
Yes, thank you for the invitation. I joined quite late, so I didn't pick up the earlier part and the details. And I was driving, but I just want to share some observation. Judging from my experience in the oil and gas, there's quite a lot of things that appear a little bit, strange here in the methodology adopting. Correct me if I'm wrong. Oil and gas companies really their valuation depends heavily on the amount of reserves they have. I'm talking about proved and probable resources or reserves. And therefore, the ability to recover these reserves is very important in the cash flow and in the forecasting of their performance of production and the decline thereof. So without considering the decline and without leveraging the reserves, would you not be undermining the capacity of the company to generate future cash flow by just looking at how things are today, what we call NFA, no further activity, for example, as opposed to being able to reinvest and produce much more than it would be today, looking into the future. So I'm talking about in comparison of comparing your method to the Norton's method, which is more universal. You're looking at companies here, but the real asset they have is reserves in the ground and nothing more than that.
Yes, yeah, and absolutely great point. And this is one that I don't get this point very often, but I really appreciate you bringing this up. And my point is that you're absolutely correct, is that reserves are extremely important in a company's valuation, because if the company does not have enough land or enough locations where they can keep this production flat for the next few years or into the future, you might be overvaluing the company, because the company needs to go out and make acquisitions, or they need to buy land, or they need to buy production. And you're absolutely correct. My overall view over the last 12 months of kind of using this methodology has been that almost every company that's out there on an oil side anyway has around 10 to 13 years of RLI, reserve life index. The only companies that deviate from that really are Cenovus, which is 30 years, and MEG, which is 62 years of RLI. So that's kind of my point that I'm trying to make, is that I run these basic calculations first on all the companies, and then I pick the companies that have the most potential based on the free cash flow generation. Now, once I run these calculations and I find the 4 or 5 best companies, that's when I would go into the reserves and look at, okay, well, MEG has 60 years of reserves and Surge only has 12. So, okay, so even though Surge or whoever else might have a higher potential, there's a lot of subjectivity into that, because MEG can maintain their production profile for 60 years. And if they were to be valued that way, there's a lot of untapped value there. And you're absolutely correct. But for the basis of this spreadsheet, where we're trying to value companies relatively based on their free cash flow generation as a first step, I think reserves can be left for now, just because every company has around 10 to 13 years of 2P reserves when you really drill down into it. So if you assume that that's equal, we don't really need to get into it until we find the companies that have the free cash flow potential. And then we see, okay, well, hey, XYZ company only has 3 years of reserves. So even though they're generating all this free cash flow, they can't keep it up. So basically, then I would exclude that company from the deep dive. So if that makes sense, kind of how I'm doing things.
Yes, thank you very much. Appreciate that.
Yeah, and really appreciate that comment. Like reserves is very, very, very important. We see companies that find new reserves and their share price goes up a lot based on that. Baytex being the most recent example. But again, that to get into those kinds of discussions, like we really need to have an understanding of what reserves are and how reserves change based on the forward strip. So it's something that I would only do once I have found my top 4 or 5 companies in the play that I'm looking for, and then we can compare them. And just a foreshadowing, I guess, is that for people who are going to be using this spreadsheet to calculate these sorts of numbers, on our White Tundra website in the next month or so, we will have graphs that show every company's reserve life index, that show every company's decline rate, that show every company's production growth for 2022, so that once you have these numbers, you can go to these graphs and say, hey, you know, you don't need to go to reserve reports by Sproul or whoever. You can just go to the website and see, okay, this company has this much reserves, this company has this much reserves. So if you want to do a deeper dive, that information will be available to people who are attending the seminar and are going to be using this this sort of methodology going forward.
Yeah, good answer. Now I have another question, if you don't mind.
Yeah,
if I'm not
sure.
pulling you back.
Yeah, go ahead.
Actually, judging from what you just explained, this is more of a screening tool, right, or screening method to screen out the
it's more of a
crop.
It's
right?
more of a relative valuation. Like you do get an absolute number from it, but it's meant to be used more as a relative between various companies in the sector. Yeah,
yes.
That's correct.
And I would like to state, therefore, would this be applicable just for peer companies within a common environment or common marketplace? Because you see, your method seems to also ignore the discount rates. Okay, there should be a significant amount of erosion of value when you look at what could happen in 8 years, as opposed to, you know, zero discounting. And discount in valuation of petroleum touches on the risk of investing and can easily differentiate between a US company operating in the US only and the US company operating in Iraq or in Africa, you know, because the risk of doing business in those other international locations or in other areas need to be factored into the recovery of the funds, whether it is, you know, exchange rate risk or political risk, because oil and gas ownership, you know, hinges on agreements, and these agreements are virtually government related or political agreements. So the affected, the risk of investing comes into play in the valuation. That's what I'm trying to say. So would you say that this method is good for comparing peer companies within a common marketplace then?
Yes, that I would say that it's built for comparing companies within the same area. So Canadian operated companies that are operating within Canada. More, you know, more to your point, like we see companies like Gran Tierra, which are in Colombia, having issues with strikes and production losses, etc. So all that kind of stuff I would take into account once I figured out my cream of the crop. I will go in and look at, okay, you know, Synovus has these assets in China and Indonesia, and then you know, certain companies have assets in Egypt or Nigeria or Colombia, and you can have your own risk factor to it. The reason I don't put any of that in here is because a lot of it is subjective. You know, someone who has operated wells in Colombia might say, okay, yeah, this is not a big deal. It's just a short-term blip. Whereas someone who has no idea and is just a retail investor looking at the industry and wants to figure out which names they want to get into, they're not going to spend hours and hours researching about geopolitical issues and social problems. So again, your point is exactly correct, that this is a very, very basic calculation from a financial standpoint, but I think the value that it gives you is to separate the top from the bottom, kind of in terms of free cash flow generation relatively. And then now your point is correct in that there might be companies we miss here, which are very high growth companies that maybe are not generating as much free cash flow because they're pumping money back into increasing production. And you know, my counter argument to that is that if we're going to get into that sort of deep discussion on these companies, you know, you really need to have a very, very deep knowledge. You almost need to have worked in the industry or have some sort of academic background in it. So, you know, for the purpose of this course being towards the generalist investor and the relative valuations, it does what it does. And then I'm always available in, you know, and if anyone wants to discuss these sorts of topics, I love discussion, because these are the topics that actually will separate the hidden gems and the companies that we, from a free cash flow standpoint, may not show the free cash flow yield, but have other positives. But yes, for the sake of this seminar, it's evaluating Canadian companies that are operating mostly in Canada and are on a low to no growth profile, which is, in my opinion, the majority of companies which are headquartered in Calgary or operate in Canada. But the oil industry is massive. There's so much nuances. There's so much speculation and subjectivity that it's really not something that we can cover. But it is extremely important. If you're going to be putting a significant amount of capital into these companies, if you're going to be, as people say, backing up the truck, etc. Yes, I would expect to go into the reserve and the production profiles and how many, what their land base is, anything to do with geopolitical issues, which we see even within Canada and within Northeast BC right now. We're having some discussions going on there. So certainly, and excellent point. Something that everyone on this call should note is that, if you're going to be investing a significant amount of money, you really need to do a deeper dive and have a better understanding. But for the sake of generalist investing, this really is the simplest way that I can put it, where you're not having to put in hours and hours of work, but you still get a very reasonable relative value of which companies are good and have potential, and which companies are not generating the cash.
Yeah, I really have to applaud your methodology. It's quite simple and more like a rule of thumb or back of the envelope, simple calculation to reduce value. But I have to look at it more in depth and study it. I would like to know more about it. And if you don't mind, maybe take it offline with you. Maybe a slight adjustment I can think about.
Sure.
Very simple as well. That will capture that reserve component and adjust your estimation of value in order not to omit or miss out from the potential capability of these companies.
Yes, awesome. No, let's definitely set something up. I will. I'll get Sohaib, and between myself, we'll because I think he would have your contact information. So
yes, I do. I'll connect both of you guys and ensure that the information is exchanged.
Awesome. Great comment and great discussion. Love it. So
are we looking at Surge right now, or are we still?
Yes. So okay. So let's move on to Surge now, which is there's a little bit different way that we calculate that one. And then whoever wants his spreadsheet after the fact, I have tabs at the bottom here for Gear, Surge, and ARC. So I'm just using the template not to show the calculations before I put the numbers in. But it's all there. So we'll close this. And we'll open up our Surge files that were also sent with the email. I just realized I haven't been looking at the chat. Okay, so we use almost the exact same method. There's not much that changes. Surge is a different valuation just for this seminar because Surge has recently gone through 2 acquisitions. They've done a share consolidation, and their Q3 results don't fully show the value of the company if you look at it from a pre-acquisition standpoint. So we'll do things a little bit differently, but almost everything is the exact same. So we'll put in our production for the quarter, which is right here. So 17,642. The liquids percentage again is you add your oil and your NGLs. So about 15,000 divided by 17,642. I think it's around 86%. That's what it comes out to. Maybe let's put 85. Now, the number of shares outstanding we see as 72.1 million. However, Surge has closed their acquisition of FarSky after Q3. So we need our today's number of shares outstanding. And this is where, you know, some of these companies, you need to understand a little bit more about what's going on. So the way that we get that is we go to the news release, which says, where is it? Or sorry, not the news release. That number is in the so I don't know where the number I got it from, but the way we calculate our shares today would be we take our number of shares at the end of third quarter, which is 72 million, and we would add the number of shares that Surge created to acquire FarSky, which is 11.2 million extra shares. So 72.2 plus 11.2, we get 83.4 million shares outstanding. And this number can also be gotten from your bank. So whatever bank you're buying shares with, or any type of broker platform, and as well as Yahoo Finance, Google Finance, or just a Google search will bring these up. The share price as of Friday, I believe, was $4.57, which gives us our market cap of 381. And if we go back to the MD&A, we see that the net debt is $320 million at the end of Q3. So we'll put 320 in there. Gives us an enterprise value of $701 million. Now, comparing Surge to Gear, we see that the debt to EV ratio is much, much higher. So Gear only had 9% of the company value as debt. Surge has 46%. Now, this could be a positive or a negative. So if you think that the oil price is going higher, you want to have more leverage in your company, because the more leverage you have, which means the more debt you have, the more that the share price valuation will increase. But if you think that the oil price is still a little bit risky, you don't believe the macro outlook, you know, you're seeing some other information out there, you know, then you might want to stay away from a company that has a higher debt to EV ratio. So this is where the relative comparisons kind of come in. The debt capacity is pretty important for Surge. And the way that we would calculate that it's all going to be in the MD&A. We're going to look at the scroll down to wherever the debt is, which in this case is page 15 for those who are following along and have the file open. So under credit facilities, we see that the amount drawn is about 190 million, and the total commitment is 215. So what that tells you is that the company has roughly $25 million of debt capacity left. So we take our current debt and we add the debt capacity left. So we get 345, 320 plus 25 that's remaining on the facilities. So a debt utilization number of 93%. So for a company that has to put it in simpler terms, if the company has a line of credit of X, they're 93% using it. So definitely we can already tell that this is a more risky play, especially if you believe that the price of oil is not stable where it is and it might go down further. So I want to make this clear, because as we will see later, the potential of surge is much higher than gear, but it comes with this risk that you have to be willing to take. Now, coming back to the subjectivity of these valuations, we don't know about this total commitment. Like, this might change at the next discussion that they have. This might change and go up, or it might go down. We don't know these things, and so a lot of it comes back down to your risk reward situation. And if you believe that the price is going up, you might be okay with a higher debt utilization number. There's a comment here about downloading the spreadsheet. I don't have it right now available. I can forward it over after the seminar. The reason I don't put it in while we go through it is because it just slows down the process a lot, as everyone, we're basically waiting for the last person who's following along to find the number and put it in. If that's something you would like in a future seminars, feel free to let me know. And if the majority of people feel that way, I'm more than happy to switch it up and run them a different way. So Surge does not have an annual dividend. And if we go up here, again, we have the adjusted funds flow is about $28 million. And the free cash flow, so we take our adjusted funds flow, we minus our exploration and development expenditures, which is, again, it's another jargon for capital expenditures. So just something you will get used to as you go through more of these. So 28 adjusted funds flow minus our capital gives us a net free cash flow of negative $6 million. So, so if you're looking at this company so far, you're thinking, oh my God, like, there's no way I'm buying this company. Their debt to EV is so high. Their debt utilization is high. They generated no free cash flow last quarter, so I'm just going to stop. Well, we need to go through the whole calculation to really understand this. And then once you have these calculations done, you can make your full, basic but very detailed information. So there's a question here about, have they been paying debt down? So no. So because they've generated negative free cash flow, the debt actually has gone up. But with all the acquisitions happening and the share consolidation, there's a lot of noise in this stock. So let's go through these calculations, and once we're done, we can go through a little bit more of the questions. So now we need to figure out what the hedging impact was. So we go to page 25 on the MD&A. We see realized gain or loss on commodity and FX contracts, FX meaning foreign exchange, is $23.2 million. So what this tells me is, it would go in as a negative because it was a loss. So we see that without the impact of this hedging, Surge actually generated 17 million of free cash flow, but their extremely poor hedging which they were forced into by their bank lenders, has created this huge loss in hedging, and so that was at a WTI of. So again, this is the exact same benchmark pricing. So we need the 17 million would have been generated at what pricing of WTI? So benchmark prices 70.56, it's right there. Strip pricing we already calculated, so it's 75.22. So if we look at it just as it is, this company is not generating that much free cash flow. It's actually below what Gear generates on an unhedged basis. But I want to bring attention to this box here, box 28. So any company that's gone through acquisitions or has gone through share consolidations, there's a lot of noise and there's a lot of potential if you can understand what the company is going to come out as. You can really find these hidden gems. So what we see here is that third quarter production was roughly 17,642 barrels a day. However, after we go through the acquisition, the company projects production of 21,500. So there's an extra 4,000 barrels of production, or BOEs, I should say, that the company has acquired and is not reflected in the Q3 results. So how are we going to value these 4,000 extra barrels? So for those that know Surge, the acquisitions that they've made is 95% oil, roughly, and it's a light oil, Southeast Saskatchewan light oil that generates incredible netbacks. The operating costs are very low, and the decline rates are not very high either. So how are we going to value these extra barrels? We go to the news release, which tells us that at $70 WTI, which is very similar to Q3 pricing, the operating netback is $52 a BOE equivalent, $52 Canadian. So another one of the things you need to know is that although these companies talk about oil pricing in US dollars, they talk about netbacks in Canadian dollars. So $52 a barrel. And we have an extra 4,000 barrels of production at 95% oil. So we just go to Google, we go 4,000 times 95% oil multiplied by the $52 a barrel of netback. So that's per day. And then we multiplied by 365 and we get 72 million of extra free cash flow that the company will generate. That is not reflected in the Q3 results. Is that making sense? How I'm calculating this? Yes.
So the reason it's not being reflected is because it's a recent acquisition, right?
Yes, because the Q3 production was 17.6. The Q4, not the Q4 production, but the production into the future will be 21,500. So it's an extra 4,000 barrels that they did not get credit for in the Q3. And the company tells us what kind of netbacks they're generating. And based on my experience with Southeast Saskatchewan wells, these light oil wells, it's pretty accurate. The operating netback, I will say, is pretty accurate. And we need to take this into account because going into 2022, this is production that the company has and has not been reflected in the Q3 results. So, once you add the 72 in here, this is when we see that at last quarter's pricing, the fair share price is more than double what it currently sits at. And if you believe in $100 oil next year, we have more than a 5x potential in share price once you add in this extra cash flow. Now, if we take it out, it's still got extreme torque to higher oil pricing. So because it's a company that their operating cost is very close to is much higher than gear. Every single dollar extra in WTI, they get a lot more cash flow torque from it. So a better way to explain this is, let's say gear's operating netback is $40 a barrel, and surge is at 60. Let's say the oil price right now is 65. So gear would generate $25 of netback per barrel, 65, which is the assumed price we're just taking for this assumption, minus their operating cost, which is 40. So they're generating 25. Surge is only generating 5 because it's 65 is the assumed oil price and 60 is their operating cost. So 25 and 5, 25 for gear, 5 for surge. Now let's say the oil price goes up to 75. Gear's operating netback goes from 25 to 35. So it's roughly a 40% increase. However, surge's netback goes from 5 to 15. So it's a 3x increase. And that's basically the best way to explain cash flow torque, is because their operating cost is much higher. Every single barrel that we go over that, they have a lot more percentage gain in the free cash flow that they generate. So,
and the reason for that is because they produce significantly more than gear. So it just comes down to barrels of production.
Yes, they produce significantly more, and also they produce a lot of heavy oil, which has a lower netback and has a higher operating cost. And the way surge is set up, they pay, because they have a lot of debt, they pay a lot of interest. So their end profit margin is lower. But as the oil price goes up, they see a relative much more higher increase percentage-wise in that operating margin, if we use that term.
And I guess another follow-up question to that is, we've seen how gear is getting a premium based on management and a bunch of other things. We've seen how surge is really getting beat up, and it's not a fan by many. So could we talk a little bit about, okay, so does the market or market participants or analysts, I should say, since a lot of the retail guys, they just rely on what the analysts are saying. So could we talk about why this name has fallen out of favor, and as to why some of the things that worked against it in the past is going to work towards it in the future?
Certainly, yeah, happy to discuss that. So when there's a lot of noise, as in a lot of acquisitions, share consolidations, a lot of analysts stay away from it. A lot of retail try to stay away from it. And it's just not a name that people want to put the effort in to really do these relatively simple calculations. And then also, while a company has released an acquisition but not closed it, the share price seems to stay within that range, just because there's guys that are known as ARB guys or ARB people who will consistently start buying the stock as soon as it falls below the deal price, and then sell it at mere cents above that deal price. So it gets stuck in this range. The other thing that's been holding surge down is that one of the private equity participants or owners of surge, whether it's from the Astra deal or the FireSky deal, does not want to stay with the company anymore. They want to go to other industries or other names, whatever it may be. We can speculate all day long, but so they're trying to get out right now and selling their position. So it puts a pressure on the pricing. And then the hedging. Surge has extremely poor hedging for Q4, but as we go through this calculation into this portion of it, you will see that the hedging is only really affecting them for Q4. The 2022 hedging is still at a loss, but it's not to the loss that Q3 and Q4 had, where you're losing $23 million a quarter on hedging. So, looking forward, if you're happy with putting money in and you think that the oil price is not going to collapse and this company is going to be forced into some sort of debt issue, and you believe that the oil price is going up, and you're willing to stick with the company for like a 3 to 6 to 12 month cycle, you know, this is your hidden gem. This is a company where if you have the patience to work through the Q4 hedging, if you have the patience for analysts to kind of move past that and look into the future, if you have the patience to wait for the macro outlook to materialize and WTI to go up to the $90, $100 range, you know, this is the company that I see that I'm invested in. More than half my portfolio and half of White Tundra's portfolio is in Surge. Just because I look at companies with risk reward, and on a relative basis, I run these calculations, and these are the numbers that come out. Again, you need to do your own due diligence. Everyone has their own sensitivities. Everyone has their own risk reward situations. So please don't take this as investment advice. It's not meant to be investment advice. It's just a calculation comparing the companies. And I believe that as the macro outlook shows us, the price will continue to increase. Surge will go through their Q4 hedging. And then analysts will come back and see like, holy, like this company is really putting out gobs of free cash flow and paying back debt or starting a share buyback program or a dividend program. So yeah.
So
I
right
have
now,
a question.
go ahead.
Oh.
So I was just going to say, right now, Raymond James has a price target of $12 and 12 cents on it. Currently, you have it priced out at around $12, somewhere around. I think that's the number I've seen at current market pricing. Yeah.
So if I put the $72 of extra free cash flow from the acquisitions in here, and we go to strip pricing, our target is $12.04. You know, on an unhedged basis, and Raymond James's, I believe, was $12.40. So they use a completely different methodology. They use net asset value calculations. But either way, what I'm trying to say is that on a relative basis, when you start comparing companies, you will start to pick up on which companies are grossly undervalued and which companies are fairly valued and which companies are overvalued on a relative basis.
I have a question. This is in regards to Surge, and you talked about private equity exiting this company. I'm very interested in these special situations because I personally bought Athabasca after Equinor dumped. So I'm just wondering, have they completed the divestment, or is that something that we're going to look forward to?
So I'll just give a little bit of context on this. So Athabasca share price was absolutely getting pressured for months. Like I first started buying Athabasca in post-COVID. Like I owned Athabasca pre-COVID as well, but post-COVID, I started buying around May 2020 because I ran these same calculations and I saw the extreme potential in the company. And the share price did nothing for 6 months. It did absolutely nothing. It was at that 18 to 20 cent range all the way until January, I believe, when Equinor dumped 100 million shares into the market. Eric Nuttall, as we know, bought, I believe, 38 million or 48 million of that.
He bought 52 million.
52 million of that. And Athabasca was almost, I want to call it the launching ground for White Tundra investments in that if you're patient with these companies that are hidden gems, that have the potential that the market is just waiting to realize, you will, you know, on a relative basis, there's a lot of potential there, as long as you have the patience to stick it out. So, you know, to have transparency, which I highly believe in transparency in this sector, which we have not gotten for the last few years. 90% of my portfolio was Athabasca in January 2021. So these companies that offer these risk reward situations, if you can run these calculations and go through them, you can see why more than 50% of my portfolio is in Surge. And as far as private equity going out, as far as I understand, FireSky, the people that own FireSky and got the $11 million shares have a 4-month lockup period on it. So that cannot be the shares that are being dumped. There was roughly, I want to say 25 to 30 million shares that the Astra deal generated, which was between 2 different private equity investors. And I believe it's one of them that's trying to get out. So back of the napkin calculations, there's roughly 12 million shares that have to go out. If you followed the surge volumes, trading volume for the last, let's say, for the last month or so, we've seen volumes in the 700 to 800K range every single day. And, you know, let's say half of that is the private equity dumping. So 20 trading days of the month, 350K shares a day, they're roughly 7 million shares out. There's about 4 million shares to dump. They may not exit fully because the trading volumes have significantly decreased in the last couple of trading sessions. So they might hold on to a small position. We don't know. And I really don't want to speculate on what they have left or who it is, because I really don't know. But my back of the napkin calculation tells me that they either have very little shares left to dispose of, or they're going to hold on to a small equity position, whether it's 3 to 4 million shares. And it's a position that I've got a lot of comments on. I've got a lot of panic and fear from people calling me and asking me about why Surge has dropped $1 over the last month, even though the deals have closed, etc. And you know, my opinion is that as soon as this private equity is done, and as we go into, you know, we're halfway through Q4 already, so analysts will begin to oversee the Q4 hedging and go into the Q1 and the 2022 numbers. And if we see an increase in WTI into the, you know, into the $90, $100 range, and WCS coming back and strengthening, you know, I guess I'll let the spreadsheet speak for itself at that point. So hopefully that answers your question and gives a little bit of clarity on my mindset on that.
No, just ask. Go ahead.
Thanks for the clarification. So generally, the private equity has mostly exited, and I think from what you explained to me, it could explain why the share price, I just pulled it up, hasn't performed that well in the last month or two.
Yeah, that's my opinion, anyways. And you know, for a portion there, like they just closed the FireSky deal on October 30th, so the whole time before that, it would have been stuck in these ARBs who are trying to make sense on the dollar just to get a, you know, pennies into their bank account kind of thing. But now that we're out of that, and now that we have this private equity situation, once this is figured out, I think there will be a lot more eyes on the sector, and there's other potential tailwinds, I guess, to the oil price. Like if the oil price continues to increase, the cash flow torque just becomes absolutely insane on this name specifically. Yeah.
When did you say that the last hedgings were off? The end of this year? End of Q4?
So I will go through it once I get to this portion of the presentation. But so the Q4 hedging is at roughly $59 Canadian, I believe it was. And then the 2022 hedging is at much higher pricing, so 70 plus dollars Canadian. So you don't see these huge hedging losses after that, where you're at $23 million lost in one quarter, which is almost $100 million a year. It's not that extreme, and it allows the company to generate the free cash flow required to give off these huge yields that you don't see with other names potentially. And their hedging is available on the corporate presentation that was sent out. It is on page 17 of the new corporate presentation. You see that they have the same number of barrels hedged, but the pricing increases substantially. Also, this is the average floor price. So each hedge has a floor price and a ceiling price. If the price of WTI trades above, higher than the hedges, the company most likely, in almost all situations, gets the ceiling price. So this is a very, very conservative estimate on the hedging situation, which I will give you the real numbers here as we go through this calculation. There's a question on the chat about hitting the targets and paying down debt. For me personally, I think we're halfway through Q4. Analysts and funds, etc., are looking at 2022 capital allocations, where they want to be. And I think people will start to realize that this is a short-term, now the short term has dragged on for 6 months, but it's a short-term pricing dislocation, which has a very good risk-reward potential, especially if you believe in the macro pushing WTI pricing higher. So I think that would be the best way of answering your question there, Sharif. Any other questions so far on?
Thank you, Shubham.
Yeah.
So when it says so $78 for quarter four 2022, $78.31, and it says average floor price, that would mean that they would have to sell for about 4,000 barrels. At which price? Because
so let me go into the hedging portion of this, because
right.
there seems to be a lot of questions on that. So just to go back to this, the free cash flow yield at strip unhedged is about 20%. So it's about double what gear was at. If we go back here into gear, at $100, it's 25% here, 42. So there is a bit more potential here on an unhedged basis, but this free cash flow yield is to the company value. Because Surge has a lot more debt, their share price valuation is going to be a lot higher, because if you're a company that has no debt, all your free cash flow is basically your free cash flow to your share price. But when you have a lot of debt, it gives you leverage. It gives you a higher torque, where if things do work out the way that these spreadsheets and the macro is telling us, your share price increase relatively is going to be a lot more, because debt doesn't increase. As oil price increases, debt stays the same. It's only your share price that can increase or decrease. So it's almost like a trampoline effect, a double whammy effect, that if you're believing in the safety and the macro outlook and the overall cash flow generation potential, there's a lot more torque in names that are highly leveraged. It doesn't offer you the same downside protection, but it gives you the upside a lot more percentage-wise. Adjusted funds flow, again, for those who want to follow this methodology, it's all here. I'm not going to go into it too much, but it's there. So now on the hedging side of things. So I always go into the MD&A, which is the management discussion and analysis, to look at the WTI hedging. So I think this is a good time for people who are interested to explain these hedges a little bit more. So the swap, a swap is basically a straight swap. So this is what the price that the company is going to get on this many barrels, regardless of what happens. Collars. These collars are basically what the company is saying is that the average bought put. So they have bought the option to sell the oil at 53. Now, current pricing is like $80 Canadian. So this average bought put is basically can be ignored, because if the company can sell oil at $80 in the market, why would they sell it at 53 and exercise this option? The average sold call. So they've given it the option of someone else. They've sold the option to someone else to buy oil at $61. Now, if the price is $80, of course, the other party is going to buy oil at $61. So the company is going to get 61.64. And then we have three-way callers. So this adds a sold put, which is basically the company has given, they've sold the option to someone else to sell oil at 44. Well, no one is going to sell them oil at 44 when they can sell it in the market at 80 bucks. So this column itself can be ignored. This column can be ignored. And this is the only column that is really going to be exercised. So what we see here is, there's 250 barrels at 64. But the majority of the hedging is here on the swaps. So about 8,000 barrels is hedged at, you can say $59 roughly. So we go here. So at 59, there's about 8,000 barrels hedged. Does that make sense how I calculated this portion of it?
Yes. The other thing I wanted to ask, the money that they get for selling the puts, okay, do we know how much they're getting for selling the puts? Because that's additional profit as well, right?
Yes. So a three-way caller is usually costless, so they don't make money and they don't lose money. So we can ignore these ones. The swaps are also usually costless because both parties are entering into the transaction. These two-way callers are where the company can make some money on the hedging. Usually it's around $2 a barrel is what the company will make on these hedging. So yeah, if you really want to go into the hedging in detail, you can take that into account. But when we're talking $60 barrel hedges or 55, the extra $2 in premium does not add enough, I think, for the time that it takes to really understand hedging and going into it for the basic calculation. And you're absolutely bang on, is that if I went through this and I figured that Surge was a company I want to do a deep dive on, I would, yes, look at the premium that they've received, which I believe is $2.30 for Surge in this case. But on an overall basis, if you look at it, it's 1,400 barrels and they got $2 a day. So $3,000 a day. It's only about 100 grand a month and $1 million a year. It's not significant to really impact the calculation that we're going for here. But great point you bring up.
So if I can, one more question.
Yep.
So I'm looking at Surge and I'm really interested in this one. I've showed you some of my stuff. I've got too many and I don't have any Surge at all. The last 2 weeks have just been a nightmare for this company. I mean, they're down since November 1st, they're down 20, what are we down here? To $1.50 a barrel. But every single day when you talk about the people selling off those shares, I mean, some of these days they sell 1.2 million, 568,000, like they're big 900,000. Yep. How many shares did you say they had to get rid of, or you figured they needed to clear off? So
I think the private equity that's trying to get out has roughly between 11 to 15 million shares. And they've been dumping not just since November 1st, but before that even, because the Astra deal, I believe the lockup period expired. It was not a long lockup period. So the company was free to be selling shares earlier as well. And again, this is all opinion and speculation because none of this is publicly released. But I believe that they only have, if they have any shares left, they only have 3 to 4 million roughly. And it's not known that they're going to dispose of these because the trading volume has dropped off in this last week or so. The trading volume has gone down a little bit, substantially actually. So they might be done with that portion of the disposition. Does that agree with kind of what you're seeing?
Yeah. I was just looking at the last day. The last day it was really low on Friday.
Yeah. So my thinking is that it's almost done, if not fully done. They might choose to hold on to some shares. There's always other tax issues and people want to claim tax losses and all kinds of things that can come into play as to why they want to hold on to a certain number of shares and not the whole thing. And I don't even want to begin to speculate on that. It's just we're going into the abyss once we start doing that. But great question.
Yeah, no, that's good.
So let me get this back to where it was. So quarter one 2022, we have about 4,000 at 76, 2,500 at 71, and 1,000 at 89. You can run the actual calculated numbers. For the sake of this, I'm just going to estimate that too many tabs open here. That it's 7,500 barrels at roughly $76. So $76, 7,500 barrels. And quarter two, it's easy to calculate. There's about 8,500 at, let's say, $81. 8,500, and you could do this forever. I only do it for the next four quarters, so the next year, because most of the target prices that analysts put out are for the next year, a 12-month period. Quarter three, they have 4,078.83, so 79, and they have 4,000 barrels. So this is what we get. Let me move this over here. Yeah, so after we're done with Surge, we'll have a 5 to 10 minute break here, and then whoever wants to stick around for ARC. And there was somebody wanted to go through Pine Cliff. I don't know if he's in this chat right now, but we can do Pine Cliff after that. So once you take the hedging into account, we see that the free cash flow yield does go down because the company has a lot of its production hedged. But at the FCF 8 multiple, we see that at strip pricing, it's at $7. So you're thinking, okay, do I really want to take this risk? And it's not really much premium here once we take the hedging into account. But if we take the Q4 2021 hedging out, which is our biggest loss, we see 940. So if you can look past Q4 and take that out of your mind that, okay, this hedging is 1 quarter only, which is more than half already done, we can see that we have at strip price, we have a doubling potential. And it just, as the WTI price goes up, the free cash flow torque, gives you every $10 in WTI, it gives you almost a 100% increase in the share price potential that you have. But, right now we need to take these hedging into account. But my whole point is that, if you want to look at these hidden gems, you need to look past the short-term noise, the price dislocations, the poor hedging that a lot of companies are in for 2021. So yeah, so that hopefully that clarifies the hedging part of it, and how I'm doing this. Like the main thing that I want to show you is on a lot of companies, if you take the Q4 hedging out, you will see an incredible potential in this company. And again, the macro outlook, I hate to keep saying the same thing, but the reason I spend so much time on the macro is so you can make your own decision on where you think oil price is going. It's not going to stay at strip. It's not going to stay at last quarter's pricing. It's going to go up or down. And if you think it's going up, this spreadsheet goes all the way to 110. You can put in whatever number you want in there and run your a calculation. So for people who are asking me as to am I selling Surge? Am I panicking out of Surge? Or am I fearful of Surge? I have not changed my position at all. I'm still holding the same number of shares that I did a month ago and that I did 3 months ago. So I'm looking past Q4. I'm looking into 2022, and I'm looking into a higher WTI pricing environment.
Shubham, I just one of the like remarkable things I've heard you saying was at one point you had like Athabasca represented about 90% of your portfolio. How long was that for? How long did you have to wait in order to see the movement in Athabasca?
So I bought a decent sized position in May, I believe, and then in June when the pricing went up and Athabasca doubled from 14 cents to 28 cents in a week, I did sell that position, and then I rebought around the 18 to 20 cent mark, 22 cent mark, a lot of shares. And like we were discussing earlier, I believe I bought 500,000 shares at the 12 cent range when it had dipped there, which I can't remember now exactly where with so many trades going on. And I basically sat on that position. I want to say it was 1.5 million shares at one point. I sat on that position, and I don't really want to say what price I sold it at for the sake of just people can calculate what the portfolio is at, but the patience was rewarded handsomely. I'll put it that way, and I believe the same for Surge, and that's why where my portfolio is now. I don't want to put 90% into one equity, but I think I'm one of the unique people who puts more than 40 to 50% of the portfolio into one single play, because I really don't believe in diversification. I think if you have a name that looks good to you, that you feel confident about, that you're willing to take the risk on, that's why Tundra's mandate is that we put 50 to 60% of our portfolio into one company, and the rest is it's all described on the website. Yeah.
And I guess a follow-up question to that, Shubham, is what did you see in Athabasca at that point that the rest of the maybe market participants or some of the analysts were missing on that name that you were able to take advantage when the market came around? So now here, with Surge, what we're looking at is the unhedged barrels that are not being taken into account as a result of the acquisition, as a big catalyst. And once that's seen, we're going to see the difference in pricing. But the question now here is for Athabasca, what was it that you seen ahead of the market?
So I saw three things in Athabasca. One was an extreme lack of trust in management, which when oil price is going up, the management quality does not really matter to the same extent as if oil price is going down, because when the oil price goes up, almost everyone makes money. When the oil price is going down, you want to be with companies that have proper risk reward scenarios. So I saw that, okay, this company, because I believe the macro that oil was going to go from $20 a barrel to whatever I believed it to be at that point. The second thing I saw was free cash flow torque. Athabasca is again a very high operating cost producer, and at a certain point, their thermal assets change from a money losing venture to a money gaining venture. So, your rate of return doesn't increase much more than dividing by zero. So once those thermal assets were brought back on, I saw, okay, these thermal assets are going to generate money, and they're going to go from generating $0 a barrel to $10 a barrel, which is an infinite increase and a huge cash flow that if you were running these calculations on the previous quarter cash flow, you would have totally missed those and not understanding the company in detail. And the third thing I saw was the fact that the debt refinancing, I always believed that it would be done because of the company's extremely solid reserve base and their barrels in the ground and their low decline rate. I had no issues in my mind that they would not run into a situation where the debt refinancing would kill them. And the debt refinancing was till February 2022. My belief in the macro was that the oil price will recover to a very significant amount before February 2022 and allow them to do this refinancing. So all these things put together, basically I backed up the truck. I put all, like I said, 90% of my portfolio into it, and I sat there. The things were looking good at 22 cents, and then the Eric Nuttall deal happened. The Equinor disposition happened. It went down to 18. I think I added even more shares at that point, and then after that, the rest is history, I guess. As we know, and as followers of Eric Nuttall know. So yeah, and again, short-term issues, people ignoring the equity, and yeah, I see the same here. And again, this is not me telling you that go out there and sell everything on Monday and buy Surge. This is a one company out of the 5 that we've done so far over the 3 seminars, and it's just about giving the information to the retail investors to do these calculations, to do their own due diligence, and make their own decisions on their own accord.
I just gotta say, you got a lot more balls than I have, because I only took a 1.5% portfolio position at the best.
Yeah, I got a lot of negative, hurtful comments, I guess, that did not faze me at all, because I believe in what I do, and it's my job is not to keep switching my mind and change my positions. It's to run these calculations, do the deep dive, find the companies, and put my money where my mouth is, kind of thing.
By the way, I actually scanned Twitter, and one of the funny things during that time when they sold when Equinor dumped was Athabasca got so much hate from the general public. It was unbelievable, and I had to do a double take after buying it, because I felt uncomfortable, because the consensus was it was just a disaster, and it's going to go bankrupt.
Yes, that was the prevailing attitude at the time. Yes, you're absolutely correct. And a lot of people panicked. Like, people had no idea what happened. Like, we had share blocks of 50 million shares transacting and 20 million volume during the day. So yeah, but again, it's to me, it's all noise. As long as you have the fundamentals, the macro, and the deep dive into the company, it's all noise. And the long term, if you have the patience to sit on these names, you have a lot of potential. As we can see here from these calculations.
So I guess maybe just another quick question, Shubham. So at May 2020, when you started your positioning with Athabasca, and you realized that you really need to hit above $60 a barrel in order to, in order for this trade to work. Like, how, I mean, the macro is really convoluted. There's so much going on. It's unpredictable. Like, how was there that much certainty that the market would be able, or the global prices would be able to turn around fast enough in time, like that it would be able to turn around prior to the financing in February, right? Because if the prices were still depressed till February came around, then that's a huge risk, bankruptcy risk, right?
Yes, oh, definitely. And I have 2 points to that. Is that one, pre-COVID, 100% of my portfolio was in energy, and I've been following macro for a lot longer, and I do a lot more deep dive into macro than what I really show in the seminar. I'm scanning data points all over the world, any data I can get, and Twitter has been an extremely huge help to that. Like, I used to scan Twitter without having an account, but now that I have the account, I'm running into more people with more data points. And pre-COVID, I already had a firm belief that U.S. shale was on the verge of losing its steam, and that the global demand was going to skyrocket. And once COVID hit, and I had a couple of months, I had February, March, April, and May to look at what COVID actually is. What's the I don't want to get into a discussion on COVID, but I looked at the data points on what the death rates were. I looked at the data points on the transmission rates. And I made a decision that, hey, I think we can get past this within the next 18 months, which puts us at February 2022 and the refinancing date. And yeah, like for me to come here and tell you that I was 100% confident would be complete BS. Like, I still had a risk in my mind, but the risk reward was such that my risk was was my principal amount that I put in, but the reward was a 10 to 20 to 30 to 50x potential when you're buying shares at 11 or 12 cents, and I was willing to take that risk. Yeah, I think that's the best way to put it. Like I could be sitting here saying a completely different story if the coronavirus situation had worsened, but it's just about looking at the macro and kind of going from there.
No, I just found that really remarkable because when I got a chance to sit down with Eric, I was asking him a question because he told me the similar thing. It was a career. If it didn't work out, it would have been a career-ending move because it's a very, but it's worked out very well for you and from him. It's what allowed him, to now move and distinguish himself. That trade is the one that allowed him to distinguish himself from the competition in terms of overachieving on portfolio performance. So, that was a very interesting answer, Shubham.
Certainly, and thanks for bringing that up. I love sharing the context of kind of how all this came about, because like you said, a lot of people think that I just came on Twitter and I'm a new participant, but I'm not a genius by any means. I'm still learning day by day, but I love sharing knowledge and I love sharing the history of how it kind of got here. But we're 2.5 hours in. I think this one's going to go longer than the last one. So let's take a 5-10 minute break. Maybe we'll come back at 45 past the hour and continue with ARC. ARC is going to be a gas and oil calculation. So people were asking that I'm only doing oil companies. So we'll go into the gas side a little bit. And yeah, some very, very interesting because ARC also has a dividend. So we'll put that into it. And we'll reconvene in 45 minutes past the hour here.
So in about what is it at 1:45 your time?
Yeah, let's do that. And then for anyone who is happy with the seminar so far, thank you so much for attending. My email, my cell is always open for discussion, feedback, suggestions, everything. This is still a test run. I think we'll need a couple more test runs to really knock down some of the things. And get this into a real course. Appreciate all your support. And we'll see you here in a little bit.
I just wanted to say before we leave, Shubham, you're a very remarkable guy. We really appreciate this. It takes a lot of time and effort. So once again, hats off to you. We'll be back in about 5-10 minutes or so, and we look forward to the second leg.
Right on. Cheers. Alrighty.
Alrighty, we're back.
Yeah, time flies when you're having fun. Okay, so yeah, so the next one that I wanted to go through was ARC. ARC is a company that I've ignored, I think, for a long time, given that I believe more in the oil plays than I do in the gas plays. But there's a couple of things with ARC that are very unique. The first being that they acquired 7 Generations in April, closed the deal in April of this year. And we often seem to forget how big they've got with that deal. They're producing over a BCF, I believe, of gas now, and 350,000 BOEs a day. And again, with all the noise, the whole 7 Gens acquisition kind of got almost lost in whatever else was going on. And 7 Gens being a company that again I highly believed in, because I was working in Grand Prairie near their operations and had an idea of the kind of phenomenal wells that they were drilling, and just the company itself, how it went from 0 to 200K BOEs a day in 5 to 6 years. Just incredible. The second thing with ARC to keep in mind is that condensate, which is ARC's main liquids production now, is selling at a premium to WTI. And with Enbridge Line 3 now online and more diluent required, which is condensate, I don't see this premium really losing its steam. So you know, like WTI trades at 80, WCS is trading at 65 roughly, and condensate trades at 85. So there's a huge pricing there. That $20 of difference between WCS and condensate almost seems to be ignored by the market and myself. Somebody had asked about ARC on the last seminar, and I basically said that I was not interested. But the free cash flow that they generated in Q3 after all the hedging that they lost money on was absolutely incredible. And it's had me going back to have a second look and doing the calculations and seeing what's going on. Compared to other gas plays, which I see a little bit more risk on, I think ARC has the perfect blend of condensate and gas exposure to the AECO market, NYMEX, and Chicago. It's a very interesting play, and we'll see why here. So there's a different template for the oil and gas. It's very similar, except we add in a couple of boxes to reflect what we think the average gas price is going to be from strip, how much it's going to increase it's still based on oil because a lot of the sensitivity to free cash flow is still oil based, but it lets you add in the gas sensitivities and also the gas hedging, the impact of the gas, and it gives you kind of a total scenario. For companies that are strictly gas, like a Pine Cliff or a Birch Cliff almost, I would use a different strategy. But for the sake of ARC, I still think it should be valued on an oil basis, with the gas being kind of a bonus, if you will. So my screen share is still working fine, hey?
Yeah, it's working fine. We see everything, Shubham.
Right on. So I'm going to close that, and I'll open the files that I sent out with the ARC presentation.
Just a side note, I think an interesting story. When I was up north, I was working at Peace River. I remember there was one individual. I don't know if I told you the story. I kept on yapping into his ear. He was a consultant. He was making $1,000 a day doing this. And I just kept on yapping into his ear about, energy and my procrastinations and whatnot. And he told me come to his truck, and he just showed me. At one point, he had sold farmland for $350,000. And he bought it. He knew Marty Proctor. It was his friend at the time. So he put it all into 7Gen. And that 350,000 ended up being 5.7 million. And he showed it to me on this. He's like, "You want oil? I'll show you some oil." And it was just so super remarkable for me. And then the other thing that was just really remarkable is the guy would show up every day, 7 a.m. in the morning, still working. So, I mean, that blew my mind, because I mean, if I had that money, I'd be in California with you right now.
Yeah.
Yeah. So just a side note, just a little story. And a lot of the things is very similar to what you were saying. I asked him, why did he pick this company? He said, look, this condensate is going to be really, really big moving forward, especially with these pipelines that they're bringing. They need to use it to be able to lighten and making the heavy oil more passable. So I see a lot of what they're producing, adding a significant premium. I mean, his ideas were very, very simple. And generally, some of the best trades are, generated with the simplest ideas, right?
Yes, no, bang on. Thank you for sharing that. And for anyone who's been to a 7Gen site, there's a lot of technology there that's very forward thinking, very, very modern. Yeah. For those who are more on the technical side, I'd be happy to discuss and share, because I love talking about that company. There's a lot of negatives as well that came with it, but yeah, I'm sure that consultant was not worried about those at the end of it all.
The other interesting thing that consultant told me is, so he's like, Undercover Boss? I said, yeah, I watched that show. He's like, listen, the real undercover boss is Marty Proctor. I said, how so? He said, this guy shows up onto site. No one knows he's the CEO of the company. He takes on maybe 1 or 2 projects a year. And with the idea of he's really trying to stay on top of the entire plant and operations and trying to get an unfiltered view for the companies and I've worked at many different plants over the years, and I've never seen anybody doing that. So, I mean, the quality of stuff he had to say about 7Gen, just leaves anybody super excited about that company. Even the people around Grand Prairie, they have such a great view of 7Gen. It's really remarkable.
Yeah, no, certainly it's one of a kind, and now it's in ARC, so now we have a chance to invest with ARC into this. So yeah, great. Thanks for sharing that. So something that is different about ARC, and something that is different about the big companies, and you have to really watch out for it, is that the way that they share their financial statements is totally misleading. There's a lot of stuff in here that you might look at the number and say, okay, these are the numbers that we're going for, except these are 2021 year-to-date numbers. So, we might go in here and, highlight page 1. We assume, just like any other company, that this is the third quarter results, but instead of that, they choose to put a year-to-date number in here, which is wrong for 2 reasons. Because 1, they acquired 7Gens in April, so this does not fully reflect what the company is actually producing. And secondly, these funds from operations and free funds flow numbers are going to be grossly overshown if you accidentally use these numbers. So as I was redoing my calculations last night, I ran into this, and I thought something I should mention, that make sure you're using the right numbers. And again, with gear, I made the same mistake. I used the wrong oil production number. So that one didn't have as big of an impact, but on this, you want to use the third quarter numbers only. That's the way the spreadsheet has been designed. So for us to get our Q3 numbers, we need to go into further down here, and so here we are. So table 7 is production. This is page 14. I don't know where to put this. Yeah, so we have total production for the 3 months ended September 30th. That's what you're looking for. So, we'll put this in here, 353,657. For companies that produce a lot of gas, they also produce a lot of what we call NGLs, natural gas liquids. Natural gas liquids are not valued at the same price as oil. NGLs consist of propane, butane, and other liquids that are valued at much lower pricing. So the one caveat that I will say in this is that I'm working on a more specific spreadsheet that will have the NGLs taken into account. But for the basis of where we are now, we're going to assume that NGLs are going to be a liquids portion of the company. And why I say this is because NGLs over the last 6 to 12 months have increased pricing substantially, where they actually are a valuable product mix right now, compared to the previous days where NGLs were selling for negative numbers, and basically it was a chore to deal with all this propane coming out, etc. But over recent times, NGL has become a valuable financial stream of income. And also NGLs have been moving up at roughly the same pricing as oil and heavy oils or condensates, etc. So for the ease of this calculation, we're going to leave NGLs as is. Going into the future, I will have a new template that will have, for companies that are like ARC, where they have gas and oil streams, about a 50-50, I will have the NGL in there. But so for this, we have liquids percentage. So you want to add your light oil, your heavy oil, condensate, and your NGLs. So your total liquid is about 137,000, which if we just do rough math, it's about 36%. I want to say 39% there. So 137, just make sure your liquids production matches this number here. You can run the numbers through a calculator and put in the exact percentage, but again, for me, it's not that important. Shares outstanding. So we want to, some of these bigger companies, it's not clear as to, they give a lot more detail than we really need. And, you can just tell that their MD&A is I believe much longer than the other ones. So you want to really go through the right numbers. So we'll look at the shares outstanding. So I'm just going to go into here and have a look. So this is the number that we're looking for. At September 30th, there were 712 million common shares outstanding. So we'll put that in. Share price, I believe, was 12.33, I want to say, as of Friday's close. So we have our current debt, or our market cap is roughly $9 billion. So we look at debt here. Debt was in the top table. So this again is unnecessarily confusing. They have a net debt number, and then they have a net debt excluding lease obligations. Lease obligations being money that they need to spend, which I don't fully understand, but I believe it has to do with any joint venture spending that they must do, any pipeline nominations that they've signed up for, and they need to spend money on that. So you want to take your net debt excluding your lease obligations, because that's the actual debt of the company, not looking into the future. Again, you can make a point that the lease obligations are an actual liability and use this number instead. But again, it goes into too much specifics. You really need to understand the nitty-gritty details, and we don't need to go there for this seminar. So debt to EV ratio, pretty low. It's more than Gear. It's less than Surge. Debt capacity, if you want, you can go look at your debt capacity. In my opinion, the debt to EV is low enough anyway that I'm not worried about a bankruptcy or anything. And the company is pretty big, so they will have a lot of backing and a lot of firepower to either they can create their own notes, they can extend their line of credits, they can dilute shares, etc. There's other ways for them to get out of it. ARC recently increased their dividend to 10 cents a quarter. So on an annualized basis, we go 40 cents a share. And everything will be calculated on its own. That's in the white boxes. So the annual dividend cash tells you how much cash does the company need to pay off this dividend. So $285 million a year, which is $71 million a quarter. Again, the two most important numbers, adjusted funds flow and free cash flow. So, if you know what you're looking for, you can just search for it and find it instead of scrolling through 48 pages of this. So cash flow, funds from operations, so 765, and our free funds flow, which is again free cash flow, which has thousands of names. It seems like everyone wants to make their own name for it. So 497. Dividend is in here already, and hedging impact for the last quarter. So again, this is one where it's unnecessarily confusing, I believe, in how they put this. So they say, if you're just scrolling and you go to page 4, this is in the third quarter of 2021, ARC recognized a loss of 524 million. So if you put this number in, it doesn't make any sense because they've lost so much money when the crude price hasn't really changed that much. And B, this is the wrong number. And for some reason, they highlighted at the start of their presentation here. So the actual number you're looking for is this right here. So change in funds from operations for the 3 months ended September 30th. Right here, risk management, they lost 155.4. So again, it's a negative because they lost money. Why are they displaying these other numbers? I have no idea, and I think it's unnecessarily misleading to people who are trying to do these calculations. I think what they're trying to say is they're including unrealized losses, so future losses in Q4 and such on the contracts that they own. But either way, be careful with the numbers that you're putting in. They need to be the actual hedging loss for that quarter only, the realized loss, not unrealized contract information and such. So benchmark pricing. So again, this is a pretty standardized table, and you'll find that the benchmark pricing actually is very similar for all the companies. So once you have one of them, you don't really need to go around and keep doing more and more of these. Strip pricing, 7522 again. Other annual FCF sources. So this is a little bit subjective. So if we go into the investor presentation, we see that ARC says that they will have synergies from the 7Gens acquisitions of roughly $160 million a year. Now, some of this is going to be captured in the Q3 results, but some of it will be synergies that they get after Q3, so in the Q4 area. So you can put, you can say that, okay, they have 50 million more synergies left to go, et cetera, et cetera. So it's really up to you. I'm going to leave it at 0 because I think a lot of synergies have already been accounted for, given that the acquisition closed in April and they've had 8 months, almost 9 months by the end of the year to go through it. But some people believe that there's more synergies, they can do optimizations, etc. Totally subjective, and it adds to the complication. I'm going to leave it simple. And then now gas price, for the sake of simplicity, again, like we had talked about WTI, that Surge or Gear don't really sell oil at WTI. They sell oil at WCS. They sell oil at Louisiana Light Blends. They sell oil at Southern Saskatchewan Blends. But if you start going into those types of pricing, A, you can't find the pricing, and B, it doesn't really affect the calculation because the differentials overall stay in a tight range and don't make that much of a difference compared to the how difficult it is to find that information and keep in track of it. So similar to that with the gas price, we're going to assume AECO pricing. Now, companies sell gas at NYMEX. They sell gas at Chicago. They sell gas at Station 2 in BC. They sell gas all over the place. There's many, many, many pricing hubs. But the point that I'm trying to make is that we want to put the last quarter gas price, which is right here for AECO, is $3.54, and we're going to put a projected gas price in. So if you're putting the projected gas price for AECO to be, let's say, $4.54, so $1 more than what they got, you can basically assume that NYMEX also is going to sell for $1 extra. You can assume that Chicago is going to sell for $1 extra. And the way we see that is if we look at June 30th to September, NYMEX is up about $1.20 US, so $1.50 Canadian. Chicago is up about $1.25 Canadian, and AECO is up roughly 70 cents Canadian. AECO has gotten a lot stronger in Q4. So this assumption is actually not a good assumption because you can actually be off by a significant amount on this. And again, when I do the NGL calculation, I will add in a NYMEX, a Chicago, and an AECO boxes, so you can actually get the true value of these change in pricing. In addition to that, you will need to know where they actually sell their gas. So most gas companies have this kind of slide in their corporate presentation. So 31% is hedged, 22% is ACO, we can say, 24% is the Midwest, so Chicago, NYMEX, etc. So we can get a lot more specific on this, but for the sake of this presentation, we'll leave it as ACO only. And so projected gas price, where do we know the projected gas price for ACO? So we're going to go back to Chrome, and PSAC, which is the Petroleum Services Association of Canada, has to the day ACO future pricing. So we go into ACO 12-month average futures, which is kind of halfway down the page. So 398 is what we're projecting for ACO for the next 12 months. So we'll close that. And I can send these links out for whoever wants this information. It's all public data. It's all easily available. You don't need to do any calculations or anything. And so the first time that I did this calculation, I was absolutely mind blown. So ARC is generating a 29% free cash flow yield at strip at last quarter's pricing, with a fair share price of more than almost triple of what the current share price is. And that's unhedged. Now, the company has a lot of hedging in the gas and oil, but on an unhedged basis, so if we look past all the hedging of 2022 into the future, it's incredible. The cash flow that the company generates is rivaling. It's better than Surge. The share potential is better than Surge, and you have much lower risk in this company. But what you lose out on is the cash flow torque, which is why I keep mentioning cash flow torque. So from the last quarter pricing to $100 oil on an unhedged basis, you gain roughly 50% in the share price fair value. Whereas if we go back to Surge, for example, from the last quarter pricing to 100, we're almost tripling the share price potential. So a lot of what companies you want to invest in is going to be based on your macro outlook. If you think oil is going 100 plus, you want to be, there's more potential in names with cash flow torque. If you are happy with pricing where it is now, or even lower than what it is right now, you can look at names like this, which are undervalued for absolutely no reason. And there's nothing really that's happened, except I think the market has totally ignored the condensate pricing and the extra 80,000 barrels a day of condensate that 7Gens brought into ARC. If we go back into this at a $40 oil price with $3.98 gas, which is what the price is right now, the share price fair value is still more than what the current share price is. Absolutely mind-boggling. So I'll let the spreadsheet do the talking. And when you look at it from an AFF basis, we look at similar kind of increases, not as big of a gap in there. I did get a comment on ARC that because of their gas drilling program and because of their acquisition of 7Gens, their capital is going to be much higher than it was in Q3. And totally fair point. So adjusted funds flow minus capital equals free cash flow. So they spent roughly $250 million on capital in Q3. But if we look at our corporate presentation, the 2022 capital program is roughly 1.2 to 1.3 billion. So it's a little bit more per quarter as they spend money drilling in the winter season on these ice roads and such, and the frost. But it really doesn't make a significant amount of difference. Like they spent 250 million in Q3, annualized that would be $1 billion. So there's an extra 200 to 300 million dollars that they're spending. And if you look at this, they're going to generate 3,100 million $3,100 million of free cash flow. So you can take out 200 from there by putting a negative 200 in there. It really doesn't affect the point, which is the relative valuation of this company is insane.
So Shubham, I remember speaking previously, I guess maybe in the last session, which was two or 3 weeks ago, and you'd mentioned that you weren't as excited with ARC, and then recently I've gotten the chance to see that you sold. You've seen it more of as a short-term earnings play. So did anything happen since then that allowed you to be really more excited than you have been previously?
Nothing has happened. I just think ARC has outperformed all their expectations on the operating cost, on the DNC cost, and many people like myself are still thinking of ARC as a gas company and have ignored it because I'm not interested in gas companies compared to oil companies, I should say. But with the 7Gens acquisition and the 80,000 barrels of condensate per day, I think ARC has been forgotten almost. And then once I finally ran these numbers, I was shocked. And I actually ran these numbers for the first time after I made that short-term play that you're mentioning. And it's a company that if you're looking at it from a safety standpoint at today's oil pricing, if you don't believe in the macro is going to keep going up, if you believe in $75, $80 oil, you're not looking for the cash flow torque to the 100 plus oil. I don't see why this would not be a name that I would be looking at versus other names. But it's all relative. Like you and I, we ran calculations on Crescent Point and Synovus at the last seminar, and there's just a familiarity with these companies. There's a subjectivity. There's a lot of ARC has a very, very poor hedging loss that I will go through here, which kind of takes out not a lot, but some of the gas from the balloon, I guess you can say. But I think it's a name that I'm more interested in now, much more interested in since we last spoke at the last seminar. Yes, you're correct.
And that's because you've taken the 7Gen into realization, which previously was. So that's the one catalyst that's made it be okay.
Yes, right. And I will say that this oil pricing calculation includes 50,000 barrels of NGL, which does not really generate the same kind of net back. So I think these numbers are a little bit inflated for sure, but it doesn't take away from the main point that the undervaluation is still quite significant, even if you take those barrels out and kind of discount them entirely, which also is not fair because NGLs and propanes and butanes are selling at very, very high pricing compared to what we've gotten for the last few years. And then propane and distillates, as we know, are in a shortage right now. So it's conservative. This share price is high, but it's not high, like super high as to what people who are not following the NGL trade might say. So so it is one that I've been looking at a little bit further, and it has dropped about 7 or 8% since its earnings high. So, there's potential here. And like I said, I don't want to make any investment advice by any means here. So I'll let the spreadsheet do the talking. The numbers are what they are. And yeah, and like there's people that believe that gas price is going to be even higher because of if there's a cold winter and there's a gas to oil switching, etc. And there's still demand for gas. Let's say AECO hits $5, it just helps the valuation. Like like as recently as last week, the projected AECO was not 398, it was 460, I believe. So there's been a drop recently because of warmer weather, but there's you can pump in whatever number you want in here, and the spreadsheet does the work for you. And as long as you understand what it's calculating, you don't really need to go into the deep dive. But like I said, I will improve the spreadsheet for NGLs, NYMEX, and Chicago pricing as well.
Just like to
Yeah, go ahead.
just like to make a comment in regards to ARC. They bought 7 generations. I put the November 2019 presentation for 7 generations. If you look to page 5, they talk about a 40% corporate decline rate in 7 generations assets.
Mm-hmm. Yes.
Wouldn't that actually dramatically, well, I wouldn't say dramatically, but it would increase their maintenance capex run rate, wouldn't it?
Yes, and that is exactly why I like to use free cash flow, because free cash flow is the money generated after keeping production flat. So ARC says that this 1.2 to 1.3 billion is going to keep production flat. If you go through the presentation, it's actually this number right here. It's 1.1 billion to sustain production. The rest is growth projects. So that's the beauty of free cash flow is that we don't even have to think about decline rates. We don't have to think about the production required or the money required to keep production flat. It's already taken into account. But if you use this adjusted funds flow number, as we had discussed earlier in the presentation, that's why in this case, this is a lot more conservative, because the decline rate on these wells is absolutely bonkers. And it's why I prefer free cash flow, because you don't need to know anything about these sorts of things that you and I, maybe know about, but the more generalist investor does not know about these Condi wells and how they decline.
So I just think in regards to that point, because for everybody in the chat, I posted their November 2019 presentation from 7 generations, and it's like you said, with the adjusted free funds from operations versus the actual decline rates and stuff. I think this is actually a pretty good example, isn't it, of like free cash flow versus AFF?
Yes, great point. Like this is one where, yes, like you really need to look at the free cash flow, because the company has high decline rates on certain wells, these Condi wells, that they need to pump in a lot of money. And we'll talk about inflation here. Like if people think that inflation in the oil field is going to be 15, 20, 25%, well, ARC might, you might put a little bit of a negative on this fair share price, because if the company needs to drill so many wells and have so much casing and tubing, etc., to keep production flat, they might see an increase in this capital program, which is going to take away from free cash flow. So it's these little things that you can do to adjust the price here and there. But yeah, this is an excellent example for the I believe yeah. So a lot of this is on an unhedged basis also, I want to say, which is why the difference here is not very big, even though the difference in adjusted funds flow and free cash flow was almost 50%. The reason the annualized numbers are not changing is because of that, I believe. But there might be an error in this spreadsheet as well. I'll make sure of that and then send out an update on that. Yeah. The CapEx is much higher than that. So
I just like to point out that it's great learning about this stuff because this is actually the oil industry and gas industry is not just drill a couple of oils. It's actually far more complicated than, I think most people can imagine.
Yeah. Oh yeah. There's the oil industry is much more complicated than it seems at the surface. There's so much going on in there that really, I'm about 8 years into it, and I'm still learning something every day, if not more things every day. And it's just about getting it bang on. But yeah, on a simplistic basis, yeah, you can run these calculations and get the numbers. But yeah, on an overall basis, if you really do a deep dive, like, my first article that I wrote on Crew Energy back in May 2020, one of my biggest points that I highlighted was the strength of the board of directors and the fact that they had incredible connections, that the company literally could not go bankrupt because they had so many ties to financial institutions and trust there. So subjectivity does play a big role in it. And again, if you're going to be investing, using my strategy where I'm investing 50, 60, 80, 90% of my portfolio into one company, you really need to understand what are the factors that affect this fair share price, and are there any reasons why it could be undervalued, whether that's management or lack of reserves or these like high interest rates, etc. But on a basic level, this gives you the firepower and the numbers you need to decide which companies are really the ones you want to focus on and learn more about and do a deep dive on. But great point on that. 7Gens had one of the highest decline rates, and were one of the most active drillers for, I want to say, the past couple of years, if not longer, just to maintain their 200K a day production. Yeah, I believe they had 11 or 14 rigs going nonstop at one point. So, so
is that an attribute common with the condes? Is they just generally decline faster?
Yes. So any well that's a condensate well, or that's an unconventional fracked well, aka shale, any shale oil in the U.S., and a lot of the Montney light oil Montney condensate stuff will decline roughly 70 to 75%, up to 70 to 75% in 1 year.
Could you repeat that, please? The condensate stuff. I just like to write that down.
So any condensate well and any shale oil well, so any unconventional well that has been hydraulically fractured, can decline up to 70 to 75%, sometimes even higher in 1 year. So if it's producing 1,000 BOEs today, it will produce 250 a year from today. So the decline is very, very high, and you really need a good rate of return on these wells to keep that going, because you need to make your cash back within the first 6 to 8 to 9 months, and then reinvest it. Because if you don't reinvest it, your production basically falls off a cliff. So
in that case, then, when we talk about oil field services inflation and the shortages on the oil field services front, this company is one of the companies, especially on the what we can see at the 7Gen acquisition part of the barrels. It's going to be heavily impacted.
Yeah, and that's why I brought up the inflation topic, in that if like people are saying oil field inflation is already 15 to 20%. Well, if you're a company that needs to drill 200 wells a year to keep production flat, your inflation is likely going to be higher. But again, keep in mind that that a lot of these big companies have long-term contracts with the likes of Trican and Calfrac and the drilling companies and such. So they might actually be better off because they have strict, firm contracts for the next year or 6 months or whatever. So, you know, you really need to understand the company, because that could be a positive or a negative depending on how you look at it.
I just want to take a little bit off topic, if that's okay, in regards to oil field services for a few minutes.
Mhm.
From what you explained to me with the decline rates and the drilling, and what you explained to me with like the Trican and the big corporations, wouldn't that make a very bullish case for small, non-major oil field services companies in Canada? Because outside the fixed contracts, any marginal capex they spend and the costs associated with that will be they're willing to, well, they just don't have much choice, so they have to pay these marginal oil field services much more money, and these little companies will produce huge cash flows whenever that marginal capex drilling comes along. Is that correct, or am I off?
That's a great point, and that's a point that I've heard from some people, and I haven't looked into it in detail, but I will play devil's advocate, and I will say that the companies, the service companies themselves, are going to be running into huge inflation problems, because the cost of steel has skyrocketed, the cost of labor has skyrocketed, and a lot of people just don't want to come back to the industry. And you know, like, they might get an extra 20, 30, 40% on the contract or the day rates, but they're ending up paying that in steel pricing and equipment maintenance. Like, the shop rate to do an oil change on your truck in Grand Prairie is more than $200 an hour. So, you know, compare that to Calgary or compare that to everywhere else. It's the inflation goes both ways. It goes on the price that you get, but also the price that you're paying for the cost of what you're of the service you provide. So I don't know enough to really comment on which one is higher, but if you think that they can jack up pricing more than they're going to lose in the cost of their services, then yes, you're absolutely right. I don't have enough faith in the data or know enough about what's going on to be confident about service companies in the way that you're kind of mentioning.
Personally, I was doing some research on the service companies, and it's kind of really interesting to take a sniff at the space, because just for some quick factoids, I don't know about North America or outside of Canada, but in Canada, the fixed amount of rigs, like the actual total amount of rigs since 2014, like if we include scrappings and decommissioning, has declined 40%. So there's actually not that many rigs available. Second of all is, I think, because if these, like you said, to counteract your point about rising inflation costs for like services and equipment, wouldn't this also increase the marginal break-even costs for new wells? So what you essentially have is, across the entire industry, the hurdle rate to drill new wells actually dramatically increases. So it puts it's kind of a reflexive part of the bull market, where it forces oil prices up, because these pricing, the cost to drill goes up, so the marginal cost of drilling new wells goes up, so it pushes oil prices even higher.
That's an excellent point, and that's a fair analysis, I think, in that you know, for people that think that shale oil or that the Montney just gonna bang on and start drilling with 300 rigs again, it's just not going to happen, because A, there's not enough people. B, the rigs that have been sitting around are not in the right maintenance. Like, people have been robbing parts to fix other rigs and stuff. So you're absolutely right, is that could be definitely how it plays out, especially in the Grand Prairie, Northeast BC area, where from what I hear from my contacts is that the service companies are having an extremely hard time raising their rates, even though their cost of labor and steel and maintenance has gone up. They're having an extremely hard time raising rates to the producers. So if that's the case, well, you know, at some point the producer will just not have any option, and the service company will just say, nope, we can't make money, so we're out, and we're leaving. So yeah, you're right. It does push the whole oil price up due to the inflation in both ways.
Because I actually got this idea because I was spending a lot of time like this year reading about the American shale oil companies. And one interesting thing that popped up in regards to shale is, for example, Pioneer Resources, one of the bigger shale companies. I looked at their break-even costs for shale wells, and this is in 2017 at the bottom of the crash, right? Yep. It was $58 if you do all-in CapEx costs. But the problem is that cost is actually artificially low because a lot of the service companies, because CapEx is a huge part of shale, like you said, I didn't know they declined 70 to 75%. That is a crazy number. So their CapEx is extremely high. So if it's $58 at the bottom of the bear market, when rig rates have collapsed 50, maybe even 70%, because I have friends who used to work in the rigs, right? And their wages and everything just collapsed. That's an unnaturally low number. And when that pushed the break-even cost in a normal market for shale oil companies closer to 70, possibly $80.
Yes. So when people talk about American shale and how, you might have heard things about how they've wasted money and done absolutely nothing in terms of free cash flow, that's why they say that, because these wells are just not, you can't keep up the treadmill. You're constantly fighting these huge declines, and then if you add on to that the fact that in Texas they're really clamping down on some of the gas flaring and the gas venting, and there's a lack of water disposal capacity, etc. It's a place where the whole drill baby drill thing, I think, is going to be tempered a little bit more than people think due to these exact reasons that you mentioned, and the money just is not there anymore from the banks and the financing side either to the same point that it was in the 2014 days, 14, 15, 16, etc. And it's one of the reasons why I'm so bullish on 100 plus oil in 2022 is when you look at the macro and you look at all these things put together, from people who have worked in the industry, who have connections in the industry, you see these things a little bit more, and I think it's going to have a huge impact. And a lot of service providers are just bare bone, like they had, like Trican for the last, if you look at the quarterly results for the last couple of years, like every result they say, hey, we've stacked this many rigs, we've stacked this many frac fleets, we've laid off this many people, right? And those people are not itching to get back. They're looking for something a little more stable than 7 years of sitting around waiting to know if they're going to have food on the table or not. So
I just like to make that comment because I actually did some research on shale, and I think that
Zauzi, is it possible for us just to finish up this spreadsheet and then do the questions right in the end?
Oh, sorry about this.
Sure, yeah, like we're almost done here, so I can finish this arc up quick, and then I'm open to any discussion after that. So if we go into the hedging again, ARC had their own legacy hedges, and then 7 Gens was known to have a lot of hedging just because of these reasons that we mentioned, in that they needed to know that that the well they drilled today is actually going to make them money before it fully declines and it's not worth anything anymore. Where are my risk management contracts? So right here. So again, very interesting hedging in that our ARC has actually hedged out all the way to 2025 on some of their production here, but basically the swaps are what they are. So you take them as is on the 3 collar hedgings, because US WTI is over this number, we take the highest number. You know, so Q4 2021, and then all of 2022 has kind of been averaged out. I'm sure if you connected with management, they would give you a breakdown of quarter by quarter. I just don't think it's important, that important. So what I'll do here is these numbers averaged out are I'll just show the actual slide where I've already calculated them, which is here. So for the next quarter, which is Q4, we have $62 a barrel on 43,000. So we have 23 here and then 20 here, gives us 43. Again, a very strange thing that ARC does. For some reason, they have their, not for some reason, I'll say it's different than other producers that we've done so far, these calculations on. They put their hedging in US dollars a barrel. So you have to convert it to Canadian dollars a barrel, because this hedging spreadsheet is all in Canadian dollars. So, you know, like we add this and this up, we say there's roughly 43,000 barrels at $50 WTI, you know, these are at 53, these are at 48, average it out to 51, which is 62 Canadian, you know, and then 2022 is all the same. So it's going to be all the same numbers. And then we have our gas hedging. And an interesting point is that companies like to refer to their gas in MCF, in BTUs, and in gigajoules, and all in the same presentation, like US dollars an MMBTU, Canadian dollars a gigajoule, but their production is given in MMCF. So the main point to note is that you must convert these into MCF before putting it in. The nice thing is that 1 MCF roughly equals 1 MMBTU. So if you're okay with that assumption, basically we take this number and the quarter. So they're losing roughly for the next year at strip pricing, they're losing roughly $360 million on the oil hedging, and the gas hedging is about 385 at strip. And so you take these two numbers out and you still get a free cash flow yield of 25%. So what does this 25% tell you? It tells you that the company can privatize and buy back all its shares and pay back all its debt in 4 years, right? Because four times 25% is 100%. So that's where that Eric Nuttall graph comes from. And once you take the hedging into account, at strip pricing, the fair share price is still double what it is right now. So, you know, this is a company that I've recently come upon this, but I don't see why I wouldn't do a deeper dive on it and try to connect with management and ask them about their hedging priorities going forward, etc. And so coming back to the PowerPoint, you know, there's a discretionary aspect to all these: management quality, insider ownership, ESG results, production growth. A company like ARC is going to run into problems because there's a lot of pushback on fracking now due to the freshwater usage and the seismic activity. So, you know, maybe that's something you need to keep into account, that, hey, ARC might run into a problem here where they're not allowed to use as much freshwater anymore, or they run into a problem. So, you know, there's that. But then if you've worked in the industry, you know that produced frack water can sometimes be recycled and reused up to the point that it doesn't become overly radioactive. So, you know, these sorts of things are just learned over the years. You're not going to be an expert on day one, but these things do affect share price a lot. However, I don't think it's something you can be taught. It's something that you either have to work in the industry, or you just learn from quarterly conference calls and analyst questions. You learn from reading the Q3 MD&As, and you just learn over time. And they will affect, once you have your top 4 or 5 companies picked, these things can actually make a big difference. Like, for example, CNRL has dividend stability, whereas Suncor doesn't. So, you know, maybe that plays a big effect on your end up final decision on what you're going to do. And then what I do is I make these charts. So what's the percentage gain from the current share price to the fair value share price? So, if you think pricing is going to stay at strip or go down, ARC is your play. It has a better potential, but the free cash flow torque of Surge really can be seen on a graph, and people love graphs. It's pretty easy to visualize. If we go back to seminar 2, same thing. We see Crescent Point has huge torque. Synovus has relatively less torque, but has the stability. Hemisphere is a small cap, micro cap play that has huge torque, and actually at today's pricing is incredibly undervalued. But we discussed Hemisphere last time, so I'll leave it at that. And seminar 2 is available on our website for anyone who wants to listen in and have a look. But yeah, at the end of it all, what I do is I take my 20 or 30 or 40 companies, I'll put them all on the same graph, and I'll make a decision. Okay, based on the macro, I see oil price at this, and based on that, I will do a deeper dive on X, Y, Z, and this companies. And that's basically that's White Tundra's mandate, and that's how I run that portfolio, and how I run my own portfolio. So that concludes the seminar. Thank you everyone again for attending. Really great discussion, great questions. I love hearing about these, people's own experiences, people's own feedback, etc. And it's just amazing. The support has been unreal. And the plan is to have these every 2 weeks. And I'm open for questions now or any discussion. And I'm always available on our website. That's my personal email here at the bottom. I'm on my American number right now. So feel free to call me, text me, or email, and yeah, we can chat. And yeah, like right now, I'll just leave it open for anyone else who wants to talk about any other companies or any other parts of the industry.
I just want to say,
I'm guessing you guys will post the recording somewhere?
Yes, yeah, it'll be on the White Tundra website, whitetundra.ca, under archived seminars.
Perfect. Thank you so much. Sorry, I interrupted someone.
Yeah. Yeah.
Oh yeah, I was gonna say that was just that was a power meeting. We're going on to 4 hours right now. Sincerely, you're the best, Shubham. You're really awesome.
Hey, thanks for putting the word out, and yeah, we'll keep on keeping on and giving knowledge and information, and you're doing a great job too with all this, so appreciate it.
Just another thing, maybe these are some really cool graphs that you've got. Maybe you down the road you could share 1 or 2 of them on Twitter. I think it will help in continuing the conversation and dialogue. It's a really powerful graph, especially you could put like today's seminar, whatever, some of the key points we went over, and then if you post this, I think it's great, because I mean that's one of the things that even when Eric was on Market Call and he mentioned is just no one's really, the conversation is very muted. It's not like tech or anything that's very crowded and you've got so many different people unearthing these value adds, right? There's just very few eyeballs that somebody like you comes along and puts 2 and 2 together, and all of a sudden you land upon these gems that aren't even on most of people's radars. So I mean, good on you. And I think maybe posting one of these graphs on Twitter will be pretty cool and continuing the conversation. You betcha. No, I will certainly, as I get into Twitter. And for those that are joining for the first time, I guess my website is fully transparent. It shows exactly what I own. I try to update it every 2 weeks. It shows I'm still building out the rest of what's going on, but eventually we have a lot to offer as White Tundra, and there's going to be all my meetings with the management are recorded, and I'm just waiting on approval to post that, and then basically you can be in my shoes and you can see what I've talked to management about, the questions that I'm asking them, all the calculations I've done. It's going to be available on there, and hopefully get some more knowledge, get some more eyeballs, and get people confident in these oil stocks. Not this thing I've been hearing for the last couple of years about oil is risky, so I'm just going to stay away from it. Like that's basically their argument. And
you can't fight an emotional argument. So let's try and get some logic in this space, get some number crunching, and some actual data. And yeah, feel free to share this recording, share the website, and send me an email or DM me or Sohaib for the next link. It'll be on the 27th of November. And feel free to invite whoever you want. I love conversation. I'm not afraid to be wrong, and I love the discussion that we can create from this kind of group of technical and financial experts and the retail investor and just everyone else who's interested. Yeah. So the floor is open if you want to come back to the service side conversation, or we can end this and we can take that offline for another time. Yeah, I'm here, and once again appreciate everyone's participation.
I'd just like to say thanks for the great presentation. It was really informative. I did some research on services. If you want to take this offline, or do people want to hear about what I discovered, or because I'm happy to share with you what I found. But we're already going on 4 hours, so that's up for everybody if they want or not.
Yeah, no, that's my main thing. But yeah, maybe let's end it for now, and then we'll reconvene, and then you and I can have a service chat, or we can do a Twitter space on that. I know Sohaib's pretty good at that, so maybe we can have something on that. And I'd love to learn more about the service companies. I've only had Trican in my portfolio for a short amount of time, but I've stayed away from service companies, but always happy to learn and have that conversation.
I'll just
I think that's a good idea. Like for the conversations that don't require screen sharing, we can put it onto the spaces, just because you'll get more people that are on the space on the oilfield services side that could add a little more insight to the matter. So we could just do that and then just take it from there. Yeah.
Well, right on. So yeah, let's end it for now. I'll try to have the recording posted by tonight. And thanks again, and have a great weekend. Cheers.
Thank you very much, man.
Yeah.
Thanks a lot.
Yeah.
Thanks. Cheers.
Thank you.
Well done.
So I think Sohaib, I will need to take the host back and then stop the recording from my end. Or no, I can stop it here.